Okay, so that looks like it. Hello, everyone.
Hello.
Thanks for coming out again. So, great big mortgage caper. The reason I'm doing this talk is because we're heading for a mortgage Armageddon. Yeah, we can all feel that the cost of living increases. Everything's going up like crazy. You know, your wages are staying static. You know, we can see where this is going. Yeah. So living costs, which take up most of people's expenses, are well, some people have told me their repayments have quadrupled, and they're going up every single month, it looks like. Yeah. Did anyone fall for the COVID mortgage holiday? Anyone? No? If you did, you can admit it. It's all right. We're all adults here. Yeah. Well, some people did, and then they found, they didn't pay for a couple of months or several months, maybe even a year, and then they were told, "Oh, now you've got to pay it back." So not much of a holiday. Yeah. This is all meant to get everybody in debt and desperate. So about 25 to 30 years ago was the last mortgage crash, right? And straight after that there was a glut of cheap houses out on the market, and the banks, they threw out their fishing lines again and hooked a new generation of suckers, right? And they had all these new products, and one of them was the interest-only mortgage. Anyone got one of those? Right, one. I'm sure there's more than one, right? You can. Okay, well, interest only sounded attractive at the time, but essentially the problem is at the end of the term you've got to come up with a lump sum, right? And most people aren't going to have that. Okay. Then there was the endowment mortgage. So it was an interest only mortgage, but you had an insurance policy which they said at the end of the term it will have accrued enough value that it will pay off the principal. But anyone who's got one of those will probably get a letter that says, "Sorry, it's not going to cover it. Yeah, they need to give us a lump sum." So that's not going to work either. Anyone got one of those adjustable rate or tracker mortgages? Nobody? Bueller? No. All right, so that was those mortgages were very attractive as well, because after 2008, after the crash of 2008, interest rates have been near to zero, right, and have stayed near to zero ever since, because they wanted to hide the effects of the 2008 crash. Okay, that 2008 crash is still happening. It didn't end, it's still going. They just kept putting money into the system, and they kept interest rates really low. So if you've got an adjustable rate mortgage, then yeah, it's been attractive because the rate hasn't changed. But now it's changing, and it's going up, and it's creeping up quite quickly. And those people who've got a tracker mortgage sort of recently, in the last 5 years, well, they were given a kind of this teaser rate type thing, that it was going to be very cheap. And then all of a sudden, after that period, which is usually 3 to 5 years, that ends. Now it goes on to whatever the current rate is. So same sort of deal. All of a sudden, now they're paying, triple, quadruple amount. So essentially, it's all being timed so that everything crashes at the same time. We can all feel that there's a financial crash on its way, and they're trying to get it all happening all at the same time. So essentially, everybody will be desperate, and what the government's going to do is sit back, let a few people commit suicide, and all this chaos happen, and then they're going to go, "Okay, we've developed the solution. It's something new. It's called the Great Reset." Yeah. And then, hopefully, as far as they're concerned, hopefully, everyone will be so desperate they'll just accept it. Yeah. So, before we talk more about mortgages, let's have a look at what money actually is. Okay. So, once upon a time, money was actually, coins, gold or silver coins. Yeah. And you would have a little pouch on your hip with all your gold and silver. In this country, it was silver. And that's why they call it, you know, pound sterling. Yeah. So you'd have your pouch of silver coins. So what happened was, the goldsmiths who would have vaults to keep all their gold in, they said, hey, you know, it's very inconvenient for you to carry all this metalwork with you, yeah, and somebody might rob you, yeah, so why don't you keep your silver in our vaults? And for every pound of silver, we'll give you a voucher, so you can claim it back whenever you want, yeah? So that seemed pretty, you know, pretty useful. So people started putting their silver in their vaults, and they were given all these vouchers. And people got very comfortable exchanging these vouchers. Right? The goldsmiths realised that, hey, only 10% of people ever actually come into the vault and ask for their money, yeah, ever ask for their silver. So what we can do is we can lend out 9 times the amount that we've got in silver, right? As long as we keep it to 9 times, and only because only 10% of people come in, right? You know, nobody will be any the wiser. So they can lend out more vouchers than they've got in silver, right? And charge interest on it as well. So essentially, they were counterfeiting money. You know, if we did it, we'd go to prison, right? But well, they did it, and they called that fractional reserve banking. Okay. Essentially, that's why the banks got massively rich, because they were defrauding people, right? And also, that's what a bank run was. So people would realise, hang on a minute, I don't think they've got my silver in the bank. So everyone would go down to the bank and go, I want my silver. So, you know, then the bank would have to shut their doors because they literally didn't have enough actual money to pay off these vouchers. Okay, so all the bank runs that you, was it Northern Rock? Yeah, Northern Rock. That wasn't a real bank run, because obviously there's nothing behind the money now. So, you know, they could just print money off if they wanted to. So really that was a consolidation event being disguised as a bank run. Okay, so yeah, they legalised the bank fraud. The thing is that, you know, when they counterfeit these vouchers, well, we have to pay it back with real assets. Okay, and if we fail to pay it back with real assets, they come and take our assets away anyway. Yeah, so to us, it's you know, a serious proposition. You know, they're just making money hand over fist, right? For us, well, there are far-reaching consequences for that. There are a lot of people who literally kill themselves over this debt, which, you know, we'll find out isn't even really a debt. Okay, so this is real money. Okay, this is a 1 ounce gold coin. All right. When I made this slide, it was around about £1,500 per ounce. Sorry?
So it's a lot more than that.
Is it now? What do you reckon it is now?
3K?
It can't be.
No,
It won't be, you know.
1600 or something.
Yeah, because here's the thing. When I was on I used to work on Wall Street, and I was writing software, and I found out that there's all these automatic systems, right? So they're looking at the market and doing things when the market reaches a certain height. If it ever reaches $2,000 an ounce, all these systems will just kick in, right? And sell or buy. I can't remember. I think it's sell. Right? So you'll see this like rise and then a sudden drop. And, yeah, but we haven't seen that yet. Anyway, yeah. So about 1,500 quid, right? Gold has never lost its value ever. Okay. In Roman times, with an ounce of gold, I could get myself a handmade toga, right? Nice pair of handmade leather sandals and a nice handmade leather belt. With 1,500 quid, I can get myself a brand new suit, right? Nice leather belt and a nice pair of leather shoes. Okay, no difference, right? The only thing that's changed between then and now is the value of the vouchers that represent it. Okay, And this is we've got, these are still those same vouchers, yeah, called bank notes. Well, it should be, and the full title is bank promissory notes, okay? Because every one of those says, I promise to pay the bearer the sum of, you know, £20. £20 of what exactly? Because there's nothing behind it. If you go to the Bank of England now with a £20 note, somebody's done this, go to the Bank of England, £20 note, say, I want my money. Yeah? They'll give you 2 tens, kick you out of there, lock the door behind you and call the police. Because they don't want the mass of the population to know that, you know, the money's worthless, it's a trick. Okay? I think it was Henry Ford who said, if the people knew how the monetary system worked, there'd be a revolution in the morning. Right? And it's true. So these are just pieces of paper with numbers on them, right? And they represent essentially a debt. Right? It's a debt that the bank owes you. Right? That's it. Okay? And they're there for exchange. Yeah? These are assets. These are just here for exchange. Okay? Medium of exchange. 97% of the money is actually in this form. You know, intangible, invisible digits on a computer screen, and that's it. Yeah, but these digits on the computer screen, what they actually represent, is not money. It is a record of what the bank owes you. But we look at that and we think it's money. It's literally just a record of what the bank owes you. Okay, it's very fine distinction, but it's a very important one. It's just another layer of abstraction from the actual money. Yeah, it's just a record of what the bank owes you, and we think that's money or credit. So before we go on to anything else, we'll have to have a look at what contracts are, right? Because, you know, there's a contract element to mortgages. So there are 4 elements to a contract, and I like to remember them with this acronym FLEM. Yeah, so I can remember it. So first one is full disclosure, right? So the terms and conditions of that contract have to be on that contract, fully disclosed. Okay. Now, a lot of times that won't be the case. And a good example is a contract that you don't know is a contract. Your driving license. Okay. You probably thought that the driving license was a certificate of competency that says that you're competent to drive a car. Yeah? But if that was the case, wouldn't the one testing you have to sign it to say you're good enough to drive? Wouldn't that be the case? Wouldn't that be the case?
Yes.
Crying out loud. Right, so they would have to sign it. Who signs it? We do. You don't have to be shy. You can say it out loud. We're all adults here, yeah. It's we sign it. So a good rule of thumb is if you sign something, it's likely to be a contract, right? Because your signature is valuable, very valuable. Okay, so the thing about the driving license contract, which is essentially waiving your natural right to travel to be something called a driver, yeah, with all sorts of fees, taxes, insurances, rules and regulations. Yeah, that's a contract. Well, it doesn't disclose all the terms and conditions because the terms and conditions of that contract are in the Road Traffic Act, away from the thing you've signed. Yeah, and you don't know everything in the Road Traffic Act, do you? Does anybody know everything in the Road Traffic Act? No. So it's not been fully disclosed to you. So that contract fails on full disclosure. Next one is lawful terms and conditions. It means that there can't be any fraud on that contract. Okay? Any element of fraud on that contract makes the contract null and void. In fact, any defect with any of these things makes the whole contract null and void and unenforceable. Okay? So yeah, there can't be any element of fraud whatsoever. Next one is equal consideration. That means both parties have to come with something of equal value. Yeah? in the case we're going to talk about, one party is coming with nothing, and you're coming with something of value. Right? So that'd be a failure of consideration. Okay. So both parties got to come with something of equal value. And the last one, manifestation of intent. That's your signature. Right? Your signature is your manifestation of intent. It's telling the world that yes, I'm going to do this, and here's my signature to say that I'm going to do it. Yeah. So on a contract, all parties to the contract must sign. So you'll find that when you look at contracts you're involved in, there'll only be one signature. Whose do you think that is? Us, yeah. So it would fail if all parties haven't signed. It fails on that. Okay. So there are also 4 ways to agree to a contract. Right. The first and most obvious one is the written contract. Yeah. So as I said, the rule of thumb: if you sign something, right, it's likely to be a contract you're signing. Yeah. Very simple. But the second one is a verbal contract. You enter into a verbal contract by answering questions. Simple as that, yeah? So when a policeman says, hello ma'am, are you the driver of this car?
No, the trouble.
Come on, let's be a muggle just for 1 minute. Hello ma'am, are you the driver of this car?
Yes.
Yes. So now we're in a verbal contract. She's admitted to being a driver. Yeah, now I can, enforce any statutes around driving on her, because now we're in agreement. Yeah. So just by answering questions, you become involved in a contract. The easy way to get out of that really is to ask a question back. Yeah. So you bounce the ball back into their court. Okay. They might ask you a question. They hit the ball back over the net. You ask the question back. Right. You never enter into a contract that way. The third way is consent implied by your actions. That's called an adhesion type contract, take it or leave it contract. An example of that might be in a car park. Somewhere in that car park there'll be a sign that says, notice, by parking in this car park, you agree to the following fees. And then there's a fee schedule. Okay? And as soon as you actually park your car there, it's now deemed that you've accepted their contract, and now these fees apply to you. Okay? And I was saying earlier to somebody, the way around that is to have your own adhesion contract in your car, saying if you issue or affix anything to my car, I charge this much. Or if you take a photograph of my car, I charge this much. And so you play them off against, or you against off them, or whatever phrase that is. Yeah, you can just bounce back between them. Yeah, you can pay my charges. I'll pay your charges. You can pay mine. And anyway, but that's consent implied by your actions. The last way is called tacit acquiescence, which means silent agreement. So if somebody makes you an offer and you're silent in the face of that offer, then they can deem that offer's been accepted. Okay. So let's go back to the schoolyard. You're a poopy head. And you don't say anything. Well, now you're a poopy head. Because you didn't go, no, I'm not. You didn't disagree. By your silence, you agreed with me. Yeah. So yes, they use this all against us all the time. Yeah. Like in court, for example, a judge might go, I'm going to fine you £250. Yeah, or I want to fine you £500. Right? Then what he's going to do, he's going to shuffle some papers, or he's going to look around the room for the next person to speak to. Yeah? But what he's really doing is pausing for you to object. And if you don't object in the little narrow window he's given you, well, now you can be deemed to have accepted his offer. Okay? Now, this happened in court once. A woman was getting prosecuted, and the judge said, well, I'm going to fine you £500. And she immediately said, I'm not doing it, I'm not paying it. No, not paying it. And the judge kind of leaned forward and he said, what about £250? Yeah, because it was an offer. And if she didn't accept it, she didn't accept it. Right, so now that we know a bit about contracts, let's have a look at the fantasy behind mortgages, because it is a fantasy. We've literally been living in Disneyland, you know, believing one thing about mortgages when something completely different is you know, at play. So let's have a look at the normal process. Okay, so here's the situation. We've got a seller over here. He's got a house for sale, and that house is valued at 100,000. Okay, and we've got the buyer over here, and he's been able to save for his sweat equity about 20,000. Sorry. So there's a problem. He's only got 20,000. The house is worth 100,000. How is he going to buy the house? So enter the banker. Hang on, let me do that again. Enter the banker. There you go. He's behind you. Yeah. All right. So enter the banker, because he's going to act as a middleman, right? To be able to allow him to buy the house. So what happens? What we think happens is the borrower makes a deposit of 20,000 sweat equity to the bank. The bank gives the borrower a loan agreement, right? And he signs it, and now the bank approves it. Okay. Then the banker lends the borrower 80,000, right? And then the borrower gives the seller 20,000. Oh, sorry, 20,000. 100,000. Okay. And now the buyer is a house owner. Yay! Yeah. But then the borrower has to pay back this mortgage over 30 years to the banker. Okay. And now they've got a house and everybody's happy. Yay, we've got a house. Yeah. The couple there, they bought a house and managed to buy a house for 20,000. Yes, they know they have to pay, you know, every month, right? But they've got a house. Yay! Yeah. The seller's happy because, you know, he goes to his bank and he goes, is that 100,000 in the bank yet? And the bank will go tap tap tap. Oh yes, it says 100,000. So now he thinks he's got money. Yeah, yay, he's happy. The banker is happy, and we're going to see exactly why they're really, really happy. Okay, but everyone's happy at this point, and nobody even bothers to even look into what's actually happening. So let's have a look at the reality. Yeah, because as I said, it's very different from what we've been told. I've had 3 mortgages in my life. Okay, and I've not known anything about any of them. You know, somebody just put a piece of paper in front of me and said, sign here and you'll get a house. I'm like, okay. And I signed it, and that's it, that's all I knew. Right? And I suspect most of you did something similar. Yeah. So, look at the word mortgage. Most people know now, it means death pledge, death grip. Yeah. It's supposed to be a millstone around your neck for the whole of your working life. That's what it's designed for. Right? Now that this model of buying houses is going away, right? Now they've switched it to the student loan. Now a student loan is supposed to be around your neck for the whole of your working life, right? But this is the model we're in at the moment, the mortgage. Okay, so let's go back to our process. So again, we've got the situation. Borrower's got 20,000 in sweat equity, and the house is worth 100,000. Enter the banker. Right, let me give you another chance. Here we go. Enter the banker. Come on, I know. We're going to have some fun in this. Right, so enter the banker. The banker apparently has lots of pieces of paper with numbers written on them that add up to 100,000. Yeah. So he's supposedly a middleman. Okay. But let's see what's actually happening.
I'd like to reflect on that. Banks are being thought of as intermediaries, but this is not really what's happening. Banks,
what are they then?
they're creators of the money supply.
So you're firmly of the view that banks create money out of thin air.
Yes, well, I produced the first empirical studies to prove that in the 5,000-year history of banking. Banks are thought of as deposit-taking institutions that lend money. The legal reality is banks don't take deposits and banks don't lend money. So what is a deposit? A deposit is not actually a deposit. It's not a bailment. It's not held in custody. At law, the word deposit is meaningless. The law courts and various judgments have made it very clear if you give your money to a bank, even though it's called a deposit, this money is simply a loan to the bank.
That's true, yeah.
So there is no such thing as a deposit.
So you think it's probably
bank.
adequately named then?
So banks borrow from the public. Okay, so that much we've established. What about lending? Surely they're lending money. No, they don't. Banks don't lend money. Banks, again, at law, it's very clear, they're in the business of purchasing securities. That's it. So you say, okay, don't confuse me with all that legalese.
No.
I want a loan. I want a loan.
Yeah.
Fine. Here's the loan contract. Here's the offer letter, and you sign. At law, it's very clear. You have issued a security, namely a promissory note, and the bank is going to purchase that. That's what's happening.
Put it in layman's terms. What does that mean?
It means that what the bank is doing is very different from what it presents to the public that it's doing. How does this fit together? So you say, fine, the bank purchases my promissory note, but how do I get my money? I want, it's a loan.
I want my
my money.
200 grand, right?
I don't care about the details. I want the money. The bank will say, well, you'll find it in your account with us. That would be technically correct. If they say, we'll transfer it to your account, that's wrong, because no money is transferred at all.
It's already
from
in the bank.
Anywhere inside the bank or outside the bank. Why? Because what we call a deposit is simply the bank's record of its debt to the public. Now, it also owes you money, and its record of the money it owes you is what you think you're getting as money, and that's all it is. And that is how the banks create the money supply. The money supply consists to 97% of bank deposits, and these are created out of nothing by banks when they lend, because they invent fictitious customer deposits. Why? They simply restate, slightly incorrectly in accounting terms, what is an accounts payable liability arising from the loan contract having purchased your promissory note as a customer deposit, but nobody has deposited any money. I wonder how the FCA deals with this, because in the financial sector you're supposed to not mislead your customers.
So did you follow that?
It's got complicated.
It's complicated. Well, simply put, right? Banks don't lend money, or they don't take deposits, right? They literally just keep a record. So if you gave the bank 20 grand to deposit with them, right? You've literally loaned them 20 grand, right? They take that 20 grand and they type in 20,000 on their computer. You think that's the money. But what happens to the 20 grand? You don't know. A guy in the bank could put it in his back pocket and walk off with it, right? You still think you've got 20 grand because they've typed in the numbers, right? And that's a record of what the bank owes you. That's it. You've lent them money. That's, you lend to the bank. It's not the other way around, okay? So when they supposedly give you a loan, well, what happens is they give you a loan agreement, right? You sign it, and as soon as you sign that loan agreement, you've created a promissory note, which is exactly the same as the bank notes, the bank promissory notes that say I owe you, or I promise to pay the bearer, yeah? So you've created money. And what the bank does is go, essentially, oh, thank you very much, here's your loan. Right? So what essentially they do is when you create the money, they buy that security, that promissory note, for credit, for numbers on their computer screen. Does that make sense? Any more sense? If it doesn't, just say so.
Not really, no.
Okay.
So you're talking about somebody that's got a bank account and they've got maybe £10,000 of savings in that bank account, but you're saying that it's not really there.
It's not really there, because all you've got is digits on a screen, and they might print it out for you, right? But the actual money is gone. You don't know where it is. It's gone. right?
So where is it? What did they do?
Where is it? What's it? Because they've given you credit. You've loaned them this paper, right? They've given you credit, numbers on the screen. Yeah. When you sign a loan agreement, right? That loan agreement, it has an amount on it. It has a date when you've got to pay it back. Yeah. And now when you sign it, it's now got your signature on it. Look at a £20 note in your pocket, right? You'll find it's got a date on it, which is on demand. Yeah. It's got an amount on it, and if you look at it, it'll have a signature from somebody from the Bank of England. Exactly the same, right? So you've created money, right? The bank buys that money you've created for credit, numbers on the screen. All they've done is a swap, right? And now they say, see those numbers on the screen, right? You can buy a house with it now, right? And now you've got to pay us that back. But they didn't give you anything. They just took what you created and gave it back to you. And now it fooled you into believing you've got to pay them back. Is that any clearer?
A bit lost. If you're buying a house, you've a deposit, say 10%, which is £20,000
Yep.
your money. So we'll keep that question aside. The banker's saying, right, we'll give you £80,000 as a mortgage.
Right.
Right. So money, at least on digits, passes between.
No. As I said, when you sign that agreement, you've created 80,000. You created the money. That's now a promissory note, just as the notes in your pocket. Yeah? You've created that. So now this is a valuable security. Okay? So what they do, the bank buys that security without you knowing. They buy it and they give you digits on the screen. So now you think, oh, I've got 80,000 in the bank now. Right? But they've literally got this money, this cash, right? And you've got this record.
Yeah, so we the public are getting Mickey Mouse figures.
Yes,
The
you were getting.
the meaningless figures.
Yeah,
the bank are working as if it's real and are getting something
it's
real.
the same as having £100,000 in silver, and they give you paper for it. Yeah, it's the same thing. It's abstracted to another level. But now it's invisible digits. It's not even real, not even paper. Yeah, so it's not the actual money. You're just getting invisible fluff.
Is that how
Okay.
they get away with buying that from? So
Sorry?
debt collectors, is that how they get away with buying it? So they're buying that security?
They're buying a debt. Yeah, they don't buy the security, but yeah, very simply, when you sign that note, that promissory note, right? They buy it. That's it, and they buy it, and they give you invisible credits. Tap 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 tap. Yeah, that's it. So, and I'm just going to re-explain it here. Oh, whenever you hear the cash register sound, means the bank's making money. Yeah. Right. So, the borrower gifts the bank 20 grand. Okay. So he literally hands over, gifts the bank 20 grand, and they type in 20 into your account. Okay. So you've just done a swap for your cash for these invisible credits. Okay. So then the bank gives the buyer a loan agreement to fill in. Right? When he signs it, the moment he signs it, it turns into cash. Okay. So now it's worth cash. Right. Just by signing it. And here's the case law that backs this up. Yeah, Fielding and Platt Limited versus Selim Jar, 1969. We have repeatedly said in this court that a bill of exchange or promissory note is to be treated as cash. It is to be honoured unless there is some good reason to the contrary. Right? So a promissory note is cash. Right? Is actual money. Okay. Now this is also backed up by the Bank of England in their quarterly report. This one's from 2014, first quarter. It says it right here. When a bank makes a loan, for example, to somebody taking out a mortgage to buy a house, it does not typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit of the size of the mortgage. At that moment, new money is created. For this reason, some economists have referred to bank deposits as fountain pen money, created at the stroke of a banker's pen when they approve loans. Right there in the Bank of England's documents. This is what they're doing. Okay? So when the guy, Dr. Richard Werner said they create fictional customer deposits, this is what they're doing here. Right? Credits their bank account with a deposit. Right? So a fictional deposit. Okay? So let's go back to our process. Oh, more money. Yeah? So the borrower, right, gives that loan agreement, right, which is now a promissory note, right, so it's worth money, right, to the bank, and now it's deposited. Okay? It's deposited and it becomes an asset on the bank's books. So as soon as it's typed in, the bank can say, now look, we've got an asset on our books now for 100,000. Right? Now remember what I was talking about, fractional reserve banking? Yeah? Literally, with that 100,000, they can now multiply this 9 times. Sometimes even more, but it's usually 10%. So they can now multiply that by 9 times. So now that 100,000 has created $1 million on their books. Okay? So let's have a look at what that actually means, how the process actually works.
We hired a detective to check it out. We gave the detective $1,000 to trace what happens to the money after depositing it in the bank. He started with the fractional reserve bank and deposited the $1,000 there to open a free account. The bank told him that all of his money is still available to him on demand. He can withdraw his deposit at any time. Our detective suspected, however, that he should take a closer look, or else he wouldn't get paid for his detective work. With a little research, he discovered that the bank only holds a part or a fraction of deposits in reserve, and that this fraction for this bank was 10%. The detective watched the teller and noticed that instead of safely depositing the entire $1,000 in the vault, she only put $100 in the vault, and then gave the other $900 to another bank customer who was asking for a loan to purchase a new TV. Something's fishy, thought the detective. Let's see what happens next. The detective followed the borrower to the electronics store where he bought the TV for $900. The store owner took the $900 he just earned from the sale of the TV and deposited it in the same bank. And the bank told him the same thing they told the detective. All of your money is still available to you on demand. You can withdraw your deposit at any time. And again, the teller took 10% of that $900 and placed it in the vault, but gave the other $810 to another borrower to buy a nice new leather jacket. Moments later, the seller of the leather jacket walked into the bank with the $810. The teller put $81 in the vault and gave $729 to another borrower. This time, an elegant lady who wanted the money for a new purse. The process repeated itself over and over again until the original deposit of $1,000 had created $9,000 additional dollars.
So that's how that literally works. These days they don't have to actually go through that process of lending so much to so many people. Literally they can go to the Bank of England and say, we've got this on our books, let's multiply it. And that's what they do. They can multiply that amount. Now, how many people think that the mortgage is the money? Anybody? Oh, I did. I don't know. I thought I was getting a mortgage and that was the money. Am I the only one?
No.
No? No? We all thought that the mortgage was the money. It's not. Right? So most lenders will, they might do it slightly differently, but they might add other documents, but what it comes down to is a promissory note that you create, right? And what's called a mortgage deed. Sometimes they have other things, offer letters or whatever, they call it different things, but it comes down to 2 main documents, yeah? A promissory note and a mortgage deed. So look at the definition of mortgage deed. A mortgage deed is a document in which the mortgagor, you, transfers an interest in real estate to a mortgagee, the bank, for the purposes of providing a loan, right? So what that means is the bank, you give the bank a mortgage. A mortgage is an interest in the house you're going to buy, so that the bank can take it away from you if you don't pay. Yeah? So literally that's what the mortgage is. It's a guarantee. It's like you give the bank an interest in the house, right, so that they can claim the house back if you don't pay. That's it. So you give the bank a mortgage, not the other way around. Right? I know, I always thought we get a mortgage. No, we give the bank a mortgage. Right? Because the mortgage is that process of giving the bank an interest in the house. Okay? I know, I was confused for a long time until I had to sit down and go, hang on, this doesn't make sense. But yeah, this is how it works. Right? You give the bank a mortgage. So who signs the mortgage contract?
Borrower.
Yeah, right. Is there anybody else who signs it in the room? Anybody remember anyone else in there signing?
Somebody for mine signed on behalf of the bank.
Somebody signed on behalf of the bank?
Yes.
Really?
That's what it says on
Was it? No, but when you were there, did somebody sign it right there?
actually maybe printed it anything, but
No, because what they do is they say, don't date it, right? We'll put the date in later, and then somebody later might sign it. But at the time, you were the only one who signed it, okay? Because here's strike one. This is the Law of Property Miscellaneous Provisions Act 1989. Right? Section 2 says it must be signed by or on behalf of each party to the contract. Right? And it has to be right there and then in each other's presence. With it can't be done later. By you not putting the date and then somebody maybe signing later, that's fraud. Because they could add things to that contract. Right? They could do all sorts of things. They could put the dates, 2 weeks earlier, or put 2 weeks later, or whatever. Right? It's fraud that it's not done in your presence. All parties concerned in the same room. Okay? That's fraud. This is strike one. Yeah? This defect alone makes the mortgage null and void. Okay? Strike one. So here's the case law for this. United Bank of Kuwait versus Saeed, 1996. No mortgage is created without a contract which complies with Section 2 of the Law of Property Miscellaneous Provisions Act 1989. Strike one. Strike two is the same bit of legislation, but now Section 1. It says it must be signed in the presence of a witness who attests the signature. So there needs to be a witness there, right, who's going to sign to say both parties are there and they're who they say they are. Okay? But was there a witness there? Anybody? No. Okay? So, strike two. Strike two. Here's the case law. Bank of Scotland plc versus War and Others, 2014. A mortgage deed must comply with Section 1 of the Law of Property Miscellaneous Provisions Act 1989. Otherwise, it is void. So, again, strike two. Either one of those will make the whole mortgage thing null and void. Okay? Third strike is this. When you sign that mortgage, you sign that document, you have transferred an interest in the house you're buying to the bank. As I said, so that the bank can take it off you if you don't pay. Okay? But here's the thing. Until you actually exchange contracts, the house isn't yours. So you're transferring an interest in somebody else's house to the bank. So imagine I'm going to borrow £1,000 off you. Yeah, I'll say, look, I'm going to borrow £1,000 off you, but if I don't pay it back, right, you can take her car. Can I do that?
No.
Oh, well, only one person thinks I can't do it. Can I do that?
No.
No, I can't, right? Nor can, nor can we. We can't do that either, yeah? Like I said, until we exchange contracts, the house is still the seller's. So when we sign that saying we're giving an interest in that house to the bank, then we're giving an interest in somebody else's house. Yeah? Totally unlawful and illegal. Okay? And here's the case law for it. Scott versus Southern Pacific Mortgages, 2014. Between exchange of contracts and completion, a purchaser cannot confer proprietary interests in the property he is purchasing on third parties. Strike 3 already. Okay, so right there, three strikes that say that loan agreement and a mortgage is unenforceable, null and void. Okay. So let's go back to our process. So the bank now lends worthless credits that total 100,000 to our buyer. Okay. Next step. Oh, bank's making money again. Yeah. So the bank, the buyer's bank, transfers the worthless credits over to the seller's bank. Now the seller can go, is that money in yet? And bank goes tap tap tap. Oh yeah, see on the screen, 100,000. Yeah. So now he thinks he's got money. All he's got is a record of what the bank owes him. Okay. So what happens next? And this is why the cash register is sounded. The bank sells that promissory note that you just signed on the securities exchange. They sell your promissory note. So let's just recap how that works. Again, your signature on that loan agreement creates a valuable security. Told you it's now cash. The bank buys that security for credit in their system, numbers on their screen. The bank now sells that loan agreement on the securities market. Now think about it. Right, that promissory note, that loan agreement, has a face value of 100,000. But over 30 years, it's going to be worth 300,000 with interest. So that is a good investment. Somebody might invest 100,000 to buy this document because they know that over 30 years they're going to get 3 times that. It's a good investment. So they might invest in that and buy it from the bank. Right? This is called securitization. So what securitization is, and you might recognise this from 2008. Yeah, anybody see the film The Big Short? Well, this is essentially what was happening back then. So, here's your mortgage pack. So you've got the mortgage deed and the promissory note. They sell the promissory note, right, into what they call mortgage-backed securities on securities exchange. Now, this mortgage-backed security is literally a stack of promissory notes for mortgages. Right? There may be 1,000, maybe 2,000 promissory notes in there. Okay, and there's hundreds and hundreds of thousands of these mortgage-backed securities. Right? All these stacks with thousands of mortgages in. So essentially, your promissory note is gone. Nobody knows where it is. Right? It's literally gone. So the point is, stepping back a second, if they're trying to say that you owe the money, the evidence that you owe the money is gone. Right? Because they've got to be holding that to say, yes, see, you owe us this money. Here's your promissory note. Yeah? But it's gone. It's in one of these stacks, they call them tranches. One of these many tranches, hundreds of thousands of them, all being bought and sold left, right and centre. Right? So nobody knows where your promissory note is. Okay?
So it all started to go wrong with the crash.
Yes, because what was happening with the crash was banks were making loans to anybody who wanted one. So people were getting loans in the names of their dogs. Right? And so, somebody would have like 3 houses, a beach house in Malibu, and their dog would have a couple of condominiums and things, and with no hope of paying them back, right? But the rating agency would look at that stack of promissory notes and say, oh yeah, everyone in here is going to definitely pay their mortgages, so it's rated A+, right? Even though nobody is going to be able to pay any of these mortgages, really. So when people actually looked in and looked at it, they just bought it for up $2 billion. They looked at it and thought, shit, nobody's going to pay this. So it all collapsed. Yeah. So The thing is, every time that security, that promissory note, is sold, there has to be paperwork, right? There has to be a transfer of ownership, right? So that, because any defect in this mortgage, right? So if the promissory note just suddenly disappears, well, that's a defect. But if there's a trail, right? So there's no defect. It's like now there's a new owner, so on and so on. But what happens is that the banks don't actually, they skip or they take shortcuts, right? They just sell, okay? So there's no paperwork. And the Americans, who are a lot further along than us, okay, they've been challenging mortgages for generations now, okay? They're further along, and they've realised that the paperwork isn't being signed, whether it's the original mortgage deal or the transfers of ownership. Okay, they realised that it's not being signed, and they started attacking the banks over that. Okay, because as I said, any defect in this process, null and void. Okay, so you're going to see what the banks did to get around it. Okay.
In my mind, this is an absolute intentional fraud.
Lynn Simoniak is fighting foreclosure, and while trying to save her house, she discovered something we did not know. Back when Wall Street was using algorithms and computers to engineer those disastrous mortgage-backed securities, it appears they didn't want old-fashioned paperwork slowing down the profits.
This was back when it was a white-hot, fevered pitch to move as many of these as possible.
When you could make a whole lot of money through securitization, and every other aspect of it could be done electronically, keystrokes. This was the only piece where somebody was supposed to actually go get documents, transfer the documents from one entity to the other. And it looks very much like they just eliminated that step altogether.
Simoniak's mortgage had been bundled with thousands of others into one of those Wall Street securities traded from investor to investor. When the bank took Simoniak to court, it first said that it had lost her documents, including the critical assignment of mortgage, which transfers ownership. But then there was a courthouse surprise.
They found all of your paperwork more than a year after they initially said that they had lost it.
Yes.
Did that seem suspicious to you?
Yes, absolutely. And what do you imagine? It fell behind the file cabinet? Where was all of this? We had it, we own it, we lost it, and then more recently, everyone is coming in saying, hey, we found it. Isn't that wonderful?
But what the bank may not have known is Lynn Simoniak is a lawyer and fraud investigator with a specialty in forged documents. She has trained FBI agents.
Did you ask for copies of those documents?
Yes.
And what did you find?
When I looked at the assignment of mortgage, and this is the assignment, a copy from my case, I looked at even the date they put in, which was 10/17/2008, was several months after they sued me for foreclosure. So what they were saying to the court was, we sued her in July of 2008, and we acquired this mortgage in October of 2008. It made absolutely no sense.
Curious, she used her legal training to go online and researched 10,000 mortgages.
Then I began to find the strange signatures.
One of the strangest signatures belonged to the bank vice president who'd signed Simoniak's newly discovered mortgage documents. The name is Linda Green, but on thousands of other mortgages, the style of Green's signature changed a lot, and even more remarkable, Simoniak found that Linda Green was vice president of 20 banks, all at the same time.
All within the same week. I mean, this is a very, very active person. And you can
Where did all those documents come from? We went searching for the Linda Green, and we found her in rural Georgia. She told us she's never been a bank vice president. In 2003, she was a shipping clerk for auto parts when her grandson told her about a job at a company called Docs, D-O-C-X. Docs, once housed here in Alpharetta, Georgia, was a sweatshop for forged mortgage documents.
They were sitting in a room signing their name as fast as they possibly could to any kind of nonsense document that was put in front of them.
Docs and companies like it were recreating missing mortgage assignments for the banks and providing the legally required signatures of bank vice presidents and notaries. Linda Green says she was named a bank vice president by Docs because her name was short and easy to spell. As demand exploded, Docs needed more Linda Greens.
So you're Linda Green.
Yes. Can't you tell?
Chris Pendley worked at Docs at the same time and signed as Linda Green.
When you came in to Docs on your first day, what did they tell you your job was going to be?
That I was going to be signing documents for using someone else's name.
Did you think there was something strange about that in the beginning?
Yeah, it seemed a little strange, but they told us and they repeatedly told us that everything was above board and it was legal.
And your previous experience in banking?
None.
In legal documents?
None.
There really were no requirements for the job.
Correct.
You had to be able to hold a pen.
Hold a pen.
But you were signing these documents as if you were an officer of the bank.
Correct.
How many banks were you vice president of in a given day?
I would guess somewhere around 5 to 6.
What were you getting paid for this?
I'm embarrassed to say. $10 an hour.
$10 an hour, that's not much for a guy who's vice president of 5 banks.
Yeah, I was very underpaid for my status in the companies.
Pendley showed us how he signed mortgage documents as Linda Green. He told us that Docs employees had to sign at least 350 an hour. Pendley estimates that he alone did 4,000 a day. This is also Linda Green. Shawana Kreit worked at Docs and says that she both signed and notarized the mortgage documents.
What was the role of the notary?
We were to make sure that everyone on the document was who they said they were and notarized the documents.
But the people who were signing the documents weren't who they said they were.
Right.
So if Chris Pendley was signing for Linda Green, you'd notarize that document.
Yes.
And you were told that was okay.
Yes.
What do you know now?
That it wasn't right.
The real Linda Green didn't want to be interviewed, but she said that some of the bank vice presidents at Docs were high school kids. Their signatures were entered into evidence in untold thousands of foreclosure suits that sent families packing.
So literally, if you remember that that Chris guy signed 4,000 a day, right? And he was just one employee out of a whole room full of employees, and that was just one company out of hundreds of those companies. You get some idea of how many people were booted out of their house on the strength of fake documents, right? So in this country, they now, because this came out in America, they don't tend to the bank won't tend to say they've sold the mortgage, the promissory note. They won't say that. They'll say they've lost it or it got damaged or something, right? Just to get around this now that this has come out. So the other thing about this securitization is a thing called bifurcation. As I said, you've got a mortgage deed and the promissory note. As soon as you sell the promissory note away from the deed, well, the thing is that both of those documents are interdependent. They're dependent on each other. Okay, one secures the other, which secures the other, and so on. So as soon as you sell the promissory note away, well now the house or the mortgage becomes an unsecured obligation. Before it's secured by the promissory note. As soon as the promissory note's gone, now it's an unsecured obligation, which means the bank can't foreclose because it's no longer secured. Okay, just to make it a bit more plain, you know, the loan agreement is secure. The promissory note is security for the loan. The house is also security for the loan, and a note is security for the house. So it's all interdependent. And if you sell one part of it away, the whole thing falls apart. Okay, because it's all interdependent. That's called bifurcation. Okay, so it's another strike against it. Another thing is what's known as redemption of security. So let's imagine I wanted to borrow £1,000 off of you, okay, and I give you my granddad's gold watch as security, right? Now let's imagine I've got my first payment to you on that £1,000, right? And I go, okay, here's the money, but you know, before I give you the money, can I see my granddad's gold watch? If you gave me a photocopy of the watch, should I accept it? No, I want to see the actual gold watch. Now, if I say, well, let me see the actual gold watch, and you say, sorry, I've sold it. Do I owe you anything now? No, because you've sold the security, right? Let's change that up a bit, okay? Let's imagine now I've been paying on that debt, right, regularly, and I'm coming to you with a final payment, okay? Once I give you that final payment, what should I get back? Well, in this case, the gold watch, the security. But yes, you're right. When you pay off the mortgage, you should get that promissory note back, because that's you saying, I'm promising to pay. Well, now you've paid, you should get that promissory note back, right? But you don't, do you? At no point, once you sold that promissory note or that gold watch, she can't fulfill her obligation at the end of the term. So the whole thing's null and void, right, all the way through, because she's already sold the security. Does that make any sense? Yeah. So there's a bit of case law, Brandau versus Burnett, 1846. Once the loan is paid off, the property held as security must be returned. Okay. Now they do a bit of sleight of hand, right, when you pay off your mortgage. Tiny bit of sleight of hand. So when I was putting this slideshow together, a friend of mine just paid off his mortgage, okay, and he got this from the Royal Bank of Scotland. It says, we'll arrange to remove the charge we hold over your property. This is known as a discharge of security. Right? Notice the word a there. Right? It's a bit of word magic, okay, because there's not just one piece of security. The house is security as well, right? And the promissory note. Sorry, the charge on the house is a security, and so is the promissory note. They've removed the charge. That's one security, right? But they haven't given you the promissory note back, right? That's why they use the word a, right? 'Cause it's a discharge of security, but it's not all discharge of security. Yeah.
A as in one. I'll give you one discharge.
Yes, one of more than one. Yeah. So this looks to you, when you read it, as they've fulfilled their obligation and they're discharging security, but they're not. They've only given you half the security. They've missed out the promissory note. They should give that back. Okay. On the same subject, interestingly, the same couple basically sent me the email they got from Land Registry, yeah, and funnily enough, all the word they keep using is proprietor, yeah. So this is to say that they now own their home outright, but they kept using the word proprietor, and it says when you look in the legal dictionary, right, proprietor. This term is almost synonymous with owner. So if it's almost synonymous with owner, what is it not? Owner. It's telling you right there that the house isn't yours. You're not the owner. Okay? So it doesn't make you might have spent 30 years paying this thing off. You're still not the owner. Right? So back to our process. More money, more money. Yeah? So this is where the buyer now works for 30 years. I've heard it's now 40 years in some cases. Yeah, for 30 or 40 years to pay back with actual assets the bank for their digital credits. Okay. So does anybody know what an amortization chart is?
What, sorry?
An amortization chart. Okay. So an amortization chart is a chart that charts the life cycle of the mortgage. Okay, so most mortgages are what's known as front-loaded interest mortgages. Okay, so in this case, it's like a 30-year mortgage. Your repayments are going to be £1,000 a month. Okay, so this chart is showing you of that £1,000, most of it is going to be interest all the way until you get to about 25 years. Right? So after about 25 years, now you're paying, more of the principal than you are paying the interest. Right? So most of the term, you're going to be paying interest only, or mostly interest. Okay. Notice around about 10 years here, there's a dotted line. Well, this is because they've got they know our psychology. Okay. Around about 7 to 10 years in, people get itchy feet. So around about 7 to 10 years, you'll start getting things like this through the door. Yeah. Oh, there are lots of houses around that are really nice. You might want to start moving. You might move into one of these nicer houses. Or you've got lots of equity in your house. You know what? You could release that equity. Maybe you can go on that holiday you've always wanted. Yeah. Or isn't it a time you renovated your house? Yeah. Why not add a second floor? Why not add an extension? Yeah. We've got this home renovation loan. Yeah. If you fall for one of these, where do you think you'll be on that amortization chart? Right back at the beginning. So you spent 7 to 10 years getting to that point. Yeah. If you fall for one of those things, you're back there again. This is how, it's a millstone around your neck for the whole of your working life. Yeah. You just end up paying interest for most of the time you're in that place. Okay. So back to more money. So virtually, and I'll explain why. Virtually, inevitably, the buyer's going to default, right, and end up homeless, right. What happens on day 91 of the mortgage default? The bank claims on a mortgage insurance that you didn't know you had, that you've been paying for, right, and they get the full value of the mortgage, right? They get it back on the insurance, okay? Then they foreclose on you, sell the house cheap at auction, okay? And here's the final kick in the teeth, more money. They'll chase you for what they perceive as a shortfall of the sale, okay? So they'll sell the house cheap, like deliberately, sell it out off cheap, right? And they say, well, yeah, we only got this much money from it, so we were expecting this with the interest, so you're going to have to pay the shortfall, yeah? So, but you know what? This isn't the biggest swindle of them all. This isn't the biggest part of the swindle. This is the biggest part, yeah? So, when the bank creates the money in the first place, they only create the principal. They don't create the interest. Now that might be a sort of tiny little point that it doesn't seem to make any sense or difference or anything. But consider this. Let's imagine there's no money in the world, right? Zero money, right? 10 people go to the bank and they borrow 100,000 each, okay? Now they spend that 100,000 into the world to buy the house, and now there's £1 million in the world, okay? Everyone with me? Right. The problem is though, each one of those people owes 300,000 with interest, yeah? So in order for them to pay their mortgages off, there needs to be 3 million in the world, but there's only 1 million. So only 3 of those people are going to be able to pay their mortgages off. There simply isn't the money there, right? The only way that those 7 are going to be able to pay their mortgages off is if the bank loans £100,000 to another 20 people. And now there's enough money for those 7 to pay their mortgages off, but now there's not enough money for the 20. So now the bank has to loan 60 people £100,000, so that 20 gets paid off. But now there's not enough money for the 60. So the bank has to, and so on, and so on, and so on. You get that? It's a pyramid scheme, it's a Ponzi scheme. Yeah? So here's the other sneaky thing. A bank can cause a depression, or the bank, and because there's only one bank really, the bank can cause a depression easily, simply by restricting the number of loans they make. As soon as they stop making the loans, now the defaults start to catch up, because there's no new money coming in, so they can pay them off. Does that make sense? So literally, as the defaults pile up, you get a depression, right? And this is what they're doing now. The banks are restricting the number of loans, right? They're making some plausible excuse, but what they're really doing is causing a depression, right? So really, it's mathematically impossible for 70% of people to pay their mortgages off. The reason we don't see it is because the timescales are so long, right? And the amount of people in the system is so big, so we don't see it happening right in front of us. Okay, but that's what's actually happening, and the bank is betting against us. Remember, it's got that mortgage insurance, yeah? So it claims when you default. So it's literally knowing that 70% of people can't pay their mortgages off, they bet against everybody, right? So that's what's known as short selling. Does anybody know what short selling is? Okay, let's just give an example. Imagine that an Apple share is worth £100. And somehow I know that in 3 months that share is going to drop in value, right? So I might go to my broker and say, could I borrow an Apple share from you? Yeah, I'll give you 20 quid just to borrow it for 3 months. Yeah, and you say, yeah, go ahead. Right, so I grab that Apple share, right, and I immediately sell it on the market. So I just sell it for £100. 3 months later, when I've got to give his share back, yeah, I now go to the market and I buy it back, and now the share's worth 40. Yeah? I buy it back, give him his share back, I pocket the 60. Does that make sense? So literally, you can make money when you know something's going to fail, right? And this is essentially what the bank's doing, right? They know that 70% of people aren't going to be able to pay their mortgages off. They take an insurance policy out so they can cash in on it. Yeah? So yeah, it's all fixed. So essentially what it is a massive game of musical chairs. But as I said, the game is so big that we don't see when the chairs start being taken away. Yeah? So the result of all this is that you end up in debt, yeah? And the bank makes something in the region of £1.8 million on that original £100,000 loan. That's it. They make money left, right and centre, right, on this one loan. So it's essentially this game. This is the game that's being played, right? We don't see how the game works, how this really works, because we never finish the game. We never properly finish this game. We finish the game when there's one person left. Well, what happens if that person carries on playing? What's going to inevitably happen? Anyone? You'll lose everything, yeah? So who's the real winner in this game? The bank. This game is rigged, so the bank always wins. And we don't realise it because we end the game too early. This world is rigged so the bank always wins. It's just been hidden with all this accounting rubbish, that we don't understand, so we don't see it. Yeah, but the game is rigged. If you look at the rules of this game, it tells you about how this game is rigged. It says the banker may also issue new money on slips of ordinary paper. Yeah? Right there, it's telling you they can counterfeit money as much as they want. So let's apply the phlegm test to the mortgage. Yeah, well, it fails on all 4 elements of this contract. Okay, you don't get full disclosure. You weren't told that you're creating the money that they're lending to you. Yeah, Lawful terms and conditions, well, it's fraud. Whole thing's fraud. So it fails on that. Equal consideration, well, you know, both sides have to come with equal value, but they didn't give you anything, right? You came with your energy, your sweat equity. They came with nothing, okay? And then manifestation of intent, only you signed the thing. So it fails on all four considerations. So the fraud and deception. The bank failed to disclose that the loan agreement was a promissory note with actual cash value. They fraudulently returned the borrower's own actual cash value in the form of a loan. The bank accepted the seller's house as security even though it didn't belong to the buyer. The bank director failed to sign the mortgage in the presence of a witness. The bank sold the promissory note on the securities market without the owner's consent. The bank accepted repayments and interest on money they never lent. The bank claims on the mortgage insurance after 90 days of default. Bank evicts the borrower and sells the house at auction, and the bank pursues the borrower for the shortfall after sale. So here's the bank losses. So they were gifted £100,000 a promissory note and deposit. They create £900,000 in assets using fractional reserve banking. They sold the promissory note for £100,000. And let's look at the worst case scenario. The bank were gifted repayments from the borrower totaling nearly the amount, let's say. Yeah. The bank receives £100,000 from the mortgage default insurance. The bank sells the house at auction for £100,000, let's say, and the bank then collects £200,000 shortfall. So somewhere in the region of 1.8 million. Right? That's their losses. What we'll do, we'll look at this court case where every single mortgage on the face of the earth was made null and void. So yeah, there was a court case in 1969. It's known as the Credit River decision. It's actually Jerome Daly versus First National Bank of Montgomery. Okay, and in this case, Jerome Daly was a lawyer, and he was being evicted from his house. And he literally got a bank representative on the stand and cross-examined him and got him to admit the bank never gave him anything, right? Which is a failure of consideration, right? And the jury decided unanimously that the bank had no claim over the house. Not only that, the judge basically ruled that because of this, all mortgages, because they're all on the same system, all mortgages are null and void for that reason. Okay. Not only that, all fiat currencies, which again work on the same system, are also null and void. Right? So bear that in mind. So what I'm going to show now, and it's going to be about 15 minutes, right? Is a recreation of the bank representative on the stand. Okay, so have a listen to what he says.
Do you believe the agreement includes a lender and a borrower?
Yes, I'm the lender and Mr. Smith is the borrower.
What do you believe the agreement is?
We have the borrower sign the note and we give the borrower a check.
Does this agreement show the words borrower, lender, loan, interest, credit, or money within the agreement?
Sure it does.
According to your knowledge, who was to loan what to whom according to the written agreement?
The lender loaned the borrower a $200,000 check. The borrower got the money and the house and has not repaid the money.
Do you believe an ordinary person can use ordinary terms and understand this written agreement?
Yes.
Okay. Do you believe you or your company legally own the promissory note and have the right to enforce payment from the borrower?
Absolutely, we own it and legally have the right to collect the money.
Does the $200,000 note have actual cash value of $200,000? Actual cash value means the promissory note can be sold for $200,000 cash in the ordinary course of business.
Yes.
So, according to your understanding of the alleged agreement, how much actual cash value must the bank loan to the borrower in order for the bank to legally fulfill the agreement and legally own the promissory note?
$200,000.
Okay, so according to your belief, if the borrower signs the promissory note and the bank refuses to loan the borrower $200,000 actual cash value, would the bank or the borrower own the promissory note?
Well, the borrower would own it if the bank did not loan the money. The bank gave the borrower a check, and that is how the borrower financed the purchase of the house.
Okay. Do you believe that the borrower agreed to provide the bank with $200,000 of actual cash value, which was then used to fund the $200,000 bank loan check back to the same borrower, and then agreed to pay the bank back $200,000 plus interest?
No, if the borrower provided the $200,000 to fund the check, there was no money loaned by the bank, so the bank could not charge interest on money it never loaned.
Okay. So if this happened, in your opinion, would the bank legally own the promissory note and be able to force Mr. Smith to pay the bank interest and principal payments?
Oh, I'm not a lawyer, so I cannot answer legal questions.
Well then, is it bank policy that when a borrower receives a $200,000 bank loan, the bank receives $200,000 actual cash value from the borrower, that this gives value to a $200,000 bank loan check, and this check is returned to the borrower as a bank loan which the borrower must repay?
Well, I do not know the bookkeeping entries.
I'm asking you if this is the policy.
I do not recall.
Okay. Mr. Banker, do you believe the agreement between Mr. Smith and the bank is that Mr. Smith provides the bank with an actual cash value of $200,000, which is used to fund a $200,000 bank loan check back to himself, which he is then required to repay plus interest back to the same bank?
I am not a lawyer.
Did you not say earlier that an ordinary person can use ordinary terms and understand this written agreement?
Yes.
Okay. Okay, Mr. Banker, I'm going to hand you back the bank loan agreement. This is Exhibit B. Is there anything in this agreement showing the borrower had knowledge or showing where the borrower gave the bank authorization or permission for the bank to receive $200,000 actual cash value from him in the note and to use this to fund the $200,000 bank loan check, which obligates him to give the bank back $200,000 plus interest?
No, there is not.
Okay, so if the borrower provided the bank with actual cash value of $200,000 in the note, which the bank used to fund the $200,000 check and returned the check back to the alleged borrower as a bank loan check, in your opinion, did the bank loan $200,000 to the borrower?
In that case, no.
So if a bank customer provides actual cash value of $200,000 to the bank, and the bank returns $200,000 actual cash value back to the same customer, is this a swap or exchange of $200,000 for $200,000?
Yes.
Okay, so did the agreement call for an exchange or swap of $200,000 to be swapped out for another $200,000, or did it call for a $200,000 loan?
A $200,000 loan.
Good. So is the bank to follow the Federal Reserve Bank policies and procedures when banks grant loans?
Yes.
So what are the standard bank bookkeeping entries for granting loans according to the Federal Reserve Bank policies and procedures? And I'll hand you now the Banker Fed publication entitled Modern Money Mechanics, labeled Exhibit C.
The promissory note is recorded as a bank asset, and a new matching deposit or liability is created. Then we issue a check from the new deposit back to the borrower.
So then, is this not a swap or exchange of $200,000 for $200,000?
Well, this is the standard way we do it.
Answer the question. Is it a swap or exchange of $200,000 actual cash value for $200,000 actual cash value? If the note funded the check, must they not both have equal value?
Well, I'm sorry, I'm going to have to plead the Fifth Amendment on this.
Okay. Tell me, if the bank's deposits or liabilities increase, do the bank's assets increase by an asset that has actual cash value?
Yes.
Is there any exception?
Not that I know of.
So if the bank records a new deposit and records an asset on the bank's books having actual cash value, would the actual cash value always come from a customer of the bank or an investor or a lender to the bank?
Yes.
All right. Is it the bank policy to record the promissory note as a bank asset offset by a new liability?
Yes, it is.
Does the promissory note have actual cash value equal to the amount of the bank loan check?
Yes.
Then, does this bookkeeping entry prove that the borrower provided actual cash value to fund the bank loan check?
Well, yes, it does. The bank president told us to do it this way.
All right. How much actual cash value did the bank loan to obtain the promissory note?
Nothing.
Then how much actual cash value did the bank receive from the borrower?
$200,000.
So then, is it true you received $200,000 actual cash value from the borrower, plus monthly payments, and then you foreclosed and never invested 1 cent of legal tender or other depositor's money to obtain the promissory note in the first place? Is it true that the borrower financed the whole transaction?
Yes.
Are you telling me the borrower agreed to give the bank $200,000 actual cash value for free, and that the banker returned the actual cash value back to the same person as a bank loan?
I was not there when the borrower agreed to the loan.
Do the standard Fed publications show the bank receives actual cash value from the borrower for free, and that the bank returns it back to the borrower as a bank loan?
Yes.
Okay. Do you believe the bank does this without the borrower's knowledge or written permission and authorization?
No.
To the best of your knowledge, is there written permission or authorization for the bank to transfer $200,000 of actual cash value from the borrower to the bank, and for the bank to keep it for free?
No.
Does this allow the bank to use this $200,000 actual cash value to fund the $200,000 bank loan check back to the same borrower, forcing the borrower to pay the bank $200,000 plus interest.
Yes.
Then if the bank transferred $200,000 actual cash value from the borrower to the bank, in this part of the transaction, did the bank loan anything of value to the borrower?
No.
Is it the bank policy to first transfer the actual cash value from the alleged borrower to the lender for the amount of the alleged loan?
Yes, it is.
Does the bank pay IRS tax on the actual cash value transferred from the alleged borrower to the bank as income?
No, because the actual cash value transferred shows up like a loan from the borrower to the bank, or a deposit, which is the same thing, so it's not taxable.
If a loan is forgiven, is it taxable?
Yes, it is.
Is it the bank policy to not return the actual cash value that they received from the alleged borrower unless it is returned as a loan from the bank to the alleged borrower?
Yes.
You never pay taxes on the actual cash value you received from the alleged borrower and keep it as bank's property?
No. No taxes paid.
When the lender receives the actual cash value from the alleged borrower, does the bank claim that it then owns it and that it is the property of the lender without the bank loaning or risking 1 cent of legal tender or other depositor's money?
Yes.
Are you telling me the bank policy is that the bank owns the promissory note, which is the actual cash value, without loaning 1 cent of other depositors' money or legal tender, that the alleged borrower is the one who provided the funds deposited to fund the bank loan check, and that the bank gets funds from the alleged borrower for free? Is the money then returned back to the same person as a loan, which the alleged borrower repays when the bank never came up with any of its own money to obtain the promissory note? Am I hearing this right? I give you the equivalent of $200,000. You return the funds back to me, and I have to repay you $200,000 plus interest. Do you think I'm stupid?
All the banks are doing this. Congress allows this.
Does Congress allow the banks to breach written agreements, use false and misleading advertising, act without written permission, authorization, and without the alleged borrower's knowledge to transfer actual cash value from the alleged borrower to the bank and then return it back as a loan?
But the borrower got a check in the house.
Is it true the actual cash value that was used to fund the bank loan check came directly from the borrower and that the bank received the funds from the alleged borrower for free?
This is true.
Is it the bank's policy to transfer actual cash value from the alleged borrower to the bank and then keep the funds as the bank's property, which they then loan out as bank loans as if they actually owned it and loaned their own money?
Yes.
Was it the bank's intent to receive actual cash value from the borrower and return the value of the funds back to the borrower as a loan?
Yes.
Do you believe that it was the borrower's intent to fund his own bank loan check?
I was not there at the time, and I cannot know what went through the borrower's mind.
So if a lender loaned a borrower $10,000 and the borrower refused to repay the money, do you believe the lender is damaged?
If a loan is not repaid, the lender is damaged.
So is it the bank policy to take actual cash value from the borrower, use it to fund the bank loan check, and never return the actual cash value to the borrower?
The bank returns the funds.
Was the actual cash value the bank received from the alleged borrower returned as a return of the money the bank took, or was it returned as a bank loan to the borrower?
As a loan.
So how did the bank get the borrower's money for free?
That's how it works.
No more questions, Your Honor.
Yeah, I'm sorry that was a bit long, but you can see how at first he was avoiding and saying no, and with cross-examination he actually ended up admitting several times that this is what's happening, right? And there's no other good reason except for this is the way we do it. Yeah. So go back to the actual case. Right, these are actual case notes you can actually find. It's still online, even though nobody knows about this case. The case is there, it's still out there, still on the books, and you can find the actual case notes right at this URL. It says the issues tried to the jury were whether there is a lawful consideration and whether the defendant had waived his rights to complain about the consideration, having paid on the note for almost 3 years. This is the bank's only defence, right? Not that we gave him a mortgage and he didn't pay it back, or he owes us or anything. No, their only argument is that because he's been paying on the mortgage for 3 years, he can't complain anymore, right? Because he's been paying, right? So by paying on the note and the mortgage, waived any right to complain about the consideration, and the defendant was stopped from doing so. Yeah, that means estoppel means once you come to an agreement, you can't go back on it. Yeah, but the result was the jury returned a unanimous verdict for the defendant. Okay, and this is a result. It is hereby ordered that the plaintiff is not entitled. The plaintiff's the bank is not entitled to recover the possession of the property, and because of a failure of lawful consideration, the note and mortgage are null and void. Right? And the sheriff's sale of the above property is null and void and of no effect. That was the result. So the ruling that came out of that court was only God can create something of value out of nothing. Yeah. Now, if you were to look up this case, anywhere about the actual case notes, right, you might find something like this. This is from Wikipedia. Yeah. So it says, however, the bank appealed the next day, right, and the decision was ultimately nullified on the grounds that a justice of the peace did not have the power to make such a ruling. Right? And the third point is, similar arguments have repeatedly been dismissed by courts as baseless. So if you read something like this, you think, oh, well, nothing happened. Yeah, he might have won the case initially, but on appeal, he lost it. Yeah. Let's have a look at the reality. Yeah. So point by point. Point one: the bank appealed. Well, we're back in the case notes, right? And it says notice of refusal to allow the appeal. So why was the appeal refused? Well, it turns out that, as I said, the ruling in the case, the result of the case was all mortgages are now null and void, and all fiat currencies are null and void. Now, to make an appeal, you have to pay the court $2, right? And they turned up at the court with 2 Federal Reserve notes, which the court had already ruled were invalid. So they couldn't pay for the appeal. So the appeal was denied. It says 2 so-called reserve and $1 Federal Reserve notes were deposited with the clerk of the court and tendered to me. These Federal Reserve notes are not lawful money. Yeah? So they couldn't actually make an appeal. It says a present determination not to allow the appeal. Okay, so yes, they appealed right the next day, but the appeal was refused. Decision was nullified because the justice of the peace didn't have the power to make such a ruling. However, did you notice anything about that? Because I said it before. A jury came to the unanimous decision, right? So a jury made the decision, and a jury's decision can't be overturned. Right? So it doesn't matter if a justice of the peace can or cannot make such a ruling. It was a jury that made the ruling. Yeah. But even besides that, the court itself, it says, it has therefore complete jurisdiction to render justice in this cause, right? So even if they said, oh, the court is invalid, no, the court has jurisdiction, right? And it's explained here. I'm not going to go through it, but no, the decision was not nullified. Okay. The third part of this was that courts dismiss these arguments as baseless. The reason courts dismiss these arguments as baseless is because the judge in this case, Judge Mahoney, was found face down in a lake full of poison. Right? They literally murdered him. Yeah? The story of the judge who was poisoned after ruling bank foreclosure is illegal and all mortgages are null and void. So they literally murdered him as a message to all other judges not to mess with mortgages. Yeah? So that's essentially the problem we have. That's part of the reason why nobody's heard of this case, because people think the cases didn't go anywhere. Okay, but this is the problem we have. The politicians, the judges, and the bankers are all in bed together, and they're covering each other's asses. Okay, but our power in this is the people, our numbers. Okay, because all these people are walking a tightrope. They're walking a tightrope because they have to be seen to be doing the right thing. Because in this game, there's millions of muggles out there, right? If they start to realise that the politicians are lying, the judges aren't dispensing justice, and the banks are cheating us, right? A revolution's going to happen. Yeah, heads will literally roll. So they've got to be seen to be doing the right thing at all times. Yeah. So essentially, that's our power. If we can start to expose what they're doing in such a way, they basically have to take a step back and let us through. Because as soon as the masses start to realise that there's something wrong, right, they're in trouble. Okay. So how do we fight back? Right. And this is all the main crux of this. How do we fight back? Well, the methods I've got is basically to spotlight the fraud, right? Spotlight the fraud and package it in the form of absolute truth, absolute bulletproof truth. And once you've got that truth in bulletproof format, you put it in your back pocket. And I've got 4 ways that you can use that truth. Okay. So anyone who's ever done any common law stuff, anyone done anything common law-ish? A wee bit, okay. So anyone who has done will kind of recognise some of these notices, okay. So normally it's a notice of conditional acceptance. We're going to use a notice of opportunity to clarify, because we don't want to frighten the bank. Yeah, we're going to use a kind of bit of a softly approach. So we don't want to scare them straight away. We're just going to, just say, oh, we're just doing an audit, a personal audit, nothing to worry about, So we've got the notice of opportunity to clarify, and the next 2 notices are kind of standard notices, essentially. So in this notice, you're basically going to say, look, I'm doing an audit, I'm after certain information, right, and you've got to give it to me because of your duty of transparency and accountability. And I'm going to give you a few days, 7 days. After day 8, you're going to be sending the notice of default and opportunity to cure. You're saying you were given 7 days, you've defaulted on my notice, but I'm a nice guy. I'm going to give you another 7 days. Yeah, and then when they fail to respond, you send the notice of default and estoppel. Remember, once you got to agreement, you can't go back on it. Estoppel by acquiescence, silent agreement, right? So they've agreed with you. You literally summarise everything that's happened so far, right? Then you say you've failed to respond. Now we're in agreement, okay? and then finally you follow that with an affidavit of truth. So you basically lay out the truth and get them to rebut all the points that you list out. And if they fail to rebut, now this affidavit becomes truth in law, a judgment in truth. So absolute bulletproof truth, because they failed to rebut it. You've made you gave them plenty of time to do so. They failed to do so, so now it's truth. Okay. Then you put that in your back pocket. Okay. So we'll have a look at the notice of opportunity to clarify. So you send it to the CEO of the bank, right? And so, dear CEO, I am currently performing an audit of my financial obligations, as previously undisclosed facts have come to my attention relating to the funding, creation and repayment of some mortgage loans. That leads me to believe that certain mortgage lenders have perpetrated massive acts of fraud upon their unwitting customers. And while I'm sure that such a reputable company as yours would not be parties to such misdeeds, I nonetheless feel I must be rigorous in my investigation into this matter. I have a number of issues that require urgent clarification in order to verify this debt. Please respond to this notice under the bank's duty of care and fiduciary duty of transparency and accountability to avoid complications and/or misrepresentation. So, what follows is a whole set of questions that are yes/no answers. Okay, so there's no wiggle room. Okay, essentially what we're asking are the same things that the prosecutor was asking, right, the bank, right, and so just basically clarifying the whole situation that we've just found out about tonight. So I'm just going to do 2 of the questions, but there's like 3 pages of questions. Okay. So is it true that that a bank deposit is in fact a loan made to the bank by the customer? Yes or no? Yeah? No wiggle room. Okay. Is it true that when I signed a mortgage agreement, I deposited a security instrument in the form of a promissory note with the bank? Yes or no? So again, there's 4 pages of this stuff. Right? So I'm going to go to the last page. If the bank is not injured by a mortgage default, is it true there can be no justification for foreclosure and sale of the mortgage property as compensation for bank losses? Yes or no? Right, so last one. So please provide the requested yes or no answers with accompanying documentation and proofs of claim if the answer is no, in affidavit format. So they're swearing under penalty of perjury, which I always thought was 25 years in prison, but somebody told me it's 7. Do you happen to know?
I don't think it's 25.
Okay, so probably
7 years is probably a good estimate.
Okay, right, so let's call it 7 years then. So yeah, you're asking them to put their neck on the line for 7 years, yeah? If they lie, then they're guilty of perjury. Right, so in affidavit format and under oath or attestation under penalty of perjury upon a full commercial liability that the facts contained therein are true, correct, complete and not misleading within 14 days of the date of this letter. If any question is answered with no, then that answer must be accompanied with a detailed explanation along with documentary evidence, not hearsay or opinion. If you fail to provide the requested information in the required format, then it will be deemed to mean that the answer to each and every question is yes. So they've got the conditions there. Either answer them or we're going to assume they're yes. Right? Once again, there is no dispute in this matter. I am simply conducting an audit for my own accounting purposes. Okay? So there's no dispute at this point. We're just asking the questions and we want answers. Okay? So as I said, the next letters are pretty standard. You summarise what's happened so far. You kind of dissect any response because they might want to try and derail you. Yeah. But just remember, did they answer your questions? Well, they won't. Okay. they're going to try and derail you by saying, "Oh, we've received your complaint." Well, hang on a minute, I didn't make you a complaint. Yeah, I'm not asking you for information, right? They might say you're disputing something. Well, I already said I'm not disputing anything. I'm just asking you for some information. And they might claim you're doing something that you're not. So I can't tell you what it is, but they'll claim something. But you've got to read what they say and rebut it, because you're simply asking them for information, which they must give you under their duty of care and duty of, what was it, financial or fiduciary accountability, yeah, because they've got your money, yeah. If you said, "Can I see how much money I've got in the bank?" They go, "No." Right? Then you know there's something going on. There's something fishy going on. They have to be totally transparent because they're dealing with your money, yeah. So you notify them that they're in default because they haven't responded with the answers, right? But you're going to give them more time. That's the gist of this notice. And then when they fail to give you the answers in the time you've given them, then you send them the default and estoppel by acquiescence. And this one again, you're going to summarise what's happened so far. On such and such a date, I sent a notice of I can't remember what it's called now. The original notice, whatever that was now. But you failed to respond in the time you were given, so I sent you a notice of default and opportunity to cure, and you were given another 7 days. You failed to respond, so now we've reached an agreement that every answer was yes. And then you'll go through and explain the affidavit process, which is what's coming next. So the affidavit process, okay? So essentially you're going to write a statement of truth under penalty of perjury, so you're going to put your neck on the line now to say that everything you're going to write here is the whole truth as far as you know, okay? So what we're going to do in this affidavit, every question that we asked, so there's about 30 questions there, right? You're going to reformat as a statement, okay? And they're going to be the things that you understand as truth because they failed to give you the answers, okay? So you're going to put all these points down and they're going to be given 40 days to respond, to rebut every single point. And they've got to rebut every single point. Any points they manage to rebut, and again, they have to rebut it with documentary evidence. They can't just say, "No, that's not right." They've actually got to give you, a detailed explanation why it's not right. Yeah. So any ones they rebut, you can remove from your affidavit. It doesn't matter. You've got 30 questions there, and they're not even going to be able to rebut one of them. Okay. And finally, you notarise it. You get it notarised by notary public. Right. Maybe costs about 60 quid sometimes, 30 to 60 quid to get a notary. Now a notary will try not to, now these days some of them will try not to sign or stamp your document. They'll look at it and go, I can't do this. But their job is just to sign to say that you signed. They've got to say that it's you who signed this. That's all. They're not really bound to look at what you're signing. Okay. Do I understand it right? You're a notary.
Yeah, that's exactly right. The notary is just a fancy witness.
Yeah.
To the signature. That's all. We don't need to know the content of the deed.
Exactly. But there's, especially down south, there's a lot of notaries now that are saying, I can't sign this. I can't witness this or anything because no, don't agree with this.
That's because he's read the content. You should really basically just the heading and how it's signed off.
Yeah.
It's got the proper wording in it. Everything in between, which is the guts of the thing, we shouldn't be interested in.
No.
We can't help ourselves.
Exactly. But they were, because I guess 10 years ago there was all these we were called free men on the land back then, right? We started using notaries to sign our documents, to give it the stamp of approval, as it were. Right? The notaries were told, not to sign any of these, not to stamp any of these. And so we go to them and they'll go, oh no, sorry, can't do that. No, can't do that. And we'd have to really hold them to their job, essentially, and say, you have to do this. All you're there to do is witness this. So do your job. Yeah. So if you don't mind, I'll take your details, because I'm putting together a list of friendly notaries.
Yeah.
Yeah. Cool. Yeah. So you get a notary to sign it and stamp it, and then you should put a nice fancy stamp with maybe a wax seal. Do you do the wax seal?
They're difficult to get. Some depends on. They did one for a wedding, common law wedding, and I brought a seal with the wax.
Right.
It's just a peel.
I like the wax seal, but
It does
it
look
looks
expensive.
cool. Yeah. Yeah. So they notarise it. Now, tell me if I've got this wrong, because with this now, if you get the notary to sign it, you can get the respondent to respond to the notary. Now tell me if you've done this at all.
No, I haven't done that.
Okay, because we've done this in England. You get the respondent to respond back to the notary. If they fail to respond in the time that you've given, the notary can write out a notice of non-response. Okay, and that can attach to your affidavit. And now they've failed to respond or rebut the your affidavit. So now that affidavit becomes truth, absolute truth. Okay, and this is a non-judicial process, so it doesn't require a court or a judge or anything. Okay.
Can they start mentioning you about before?
Sorry?
Can they start mentioning you about, close your account and tell them you moved your mortgage somewhere else?
Well, what for? I mean, at this point, you've not done anything. You've just said, I'm doing it.
I know what's coming.
Well, again, it's not about what they think might be coming. All you've done is saying, look, I'm doing an audit for my own personal use. I just want these answers. Well, hang on a minute, you're not giving me the answers. Can I have just these answers? You know, what have you done? Yeah?
Can you do this after you've paid your mortgage off?
Yes, you should be able to as well, because you'll see when we get to the part about how we go after the banks, yeah, you'll see what I'm talking about. So here's a basic affidavit, right? So the only thing that's kind of missing is at the top you might say, this is the respondent, you know, the bank, the CEO and the CFO of the bank, or whoever you want to add to it, and you are the what's known as the affiant, okay? So you put the parties up the top there. So affidavit claims verifies a statement of facts. I, a man commonly known as Dave Murphy, here in the affiant, and I am competent to state the following matters, that they are true, correct, complete, presented in good faith and not intended to mislead. And then, as I said, every single one of those yes/no questions, you just reformat as a statement. Yeah. So it is the affiant's understanding that when the respondent accepts a bank deposit, it is in fact a loan made to the bank by the customer, and the affiant believes there is no material fact or evidence to the contrary. So that's your statement of truth. You're saying this is what I believe, okay, based on the fact they couldn't respond to your question. Okay. It is the affiant's understanding that when the affiant signed the mortgage agreement, the affiant deposited a security instrument in the form of a promissory note with the respondent, and the affiant believes there is no material fact or evidence to the contrary. So you just do that with all the maybe 30 odd questions. Okay. So at the end, again, you sign it and you get the notary public to stamp, and that's it. Now your affidavit is matured. Okay, so I'll just play a little thing about affidavits.
A properly executed affidavit is law until it is rebutted by another affidavit. Suppose you send your mortgage lender an affidavit that says you just discovered that the loan documents they asked you to sign have misrepresentations, lack of disclosure, or fraud. If you are wrong, you may go to jail for perjury. If you're right, you may get the deed to your house free and clear. An affidavit is a powerful thing. The author of an affidavit can take all the marbles. He can make the rules. In my affidavit, I can say, You hereby agree to pay me $50 a month unless you rebut this affidavit within 30 days. If you make the mistake of tossing that affidavit into your inbox and forgetting about it, 30 days later you are a slave to me. Under the law, $50 per month of your earnings belongs to me. If your notice is in the form of an affidavit, no judge, court, or officer may deny your claim, and the credit card company may not impose different terms unless you agree to them either by response or by silence. An affidavit is not a complicated thing. Samples of them are easy to find. There's no particular layout that's required. Basically, it's a sworn statement of true and complete fact with a date and a notarized signature. If it affects another party, it must be presented to that party with a reasonable time for response. Large institutions are very good at sending notices, but they are not very good at reading and responding to notices they receive. That is not your problem. Institutional size and bureaucratic incompetence is not an excuse for
anything. Okay, I don't know why I got chopped off the end there. So that would form your pack of absolute truth in bulletproof format. Okay, you can add to that something called a securitization audit. Okay, now there are only American companies doing this at the moment, but this particular company is actually doing it in England. So there's a guy that I know, I did this talk for, he's actually with this company and they're doing the audit for him at the moment. Okay. Now what securitization audit will do, it will trace the life cycle of your promissory note. So, you know, I told you that once it's sold in securitization, it's gone. Yeah, it's in one of those tranches, and now it's been bought and sold left, right, and centre with hundreds of thousands of others. But there is a way, somehow, I don't know how, but there is a way to track where that promissory note has gone. Right, so the whole path that it's gone and where it is currently. Okay, and these people can do a forensic sort of deep dive into where this promissory note's gone. And you know, in America, they literally will go to court, and they're a forensic witness. Okay, it'll also tell you if the bank has collected on the mortgage insurance. Okay, so now you've got evidence, you know, rock solid evidence that the bank doesn't own the promissory note anymore, and who does own the promissory note, and the fact that they've already had the mortgage paid out for. Okay, so if you get that, unfortunately it's about 1,200 quid to get one of these, and I've only got maybe 2 or 3 companies that are doing it in this country, so I'm also compiling a list of these companies as well. Again, it's just something to add, you know, as your packet of truth, as it were. So now that you've got the truth in your back pocket, right? So I'm going to give you a few approaches to, you know, what you can do with that truth. Okay, so they're going to vary in difficulty and scariness. Okay, so depending on how confident you feel, you can choose one or the other. Okay, so the easiest, the least scary approach is to just pay them. Okay, which after what you've heard might seem a bit counterintuitive, but again, paying them is the least scary option. Right? So how we're going to pay them is with a promissory note. Okay, exactly the same instrument that brought the mortgage into existence in the first place. Yeah. So this is a promissory note that it's a version of one that I've used to pay a court fine. Actually, I paid an £895 court fine with a promissory note, just very similar to this. So got promissory note on there. I've got my own unique serial number, and we'll see about that, what that's about later on. The amount in numbers and letters. The reason why, and you might have noticed, the reason why there's, you know, you put numbers and letters. Who was here last night, by the way? So for you, so you already know. It's a sum certain, okay? So I won't go into that. It means you're really talking about money. So I, Dave Murphy, promise to pay the bearer on demand the sum of, and there's the amount, and subsequent to the Bank of England having honoured their promise on their banknotes. And there's my signature. I've, just to be fancy, I put my thumbprint there. It's not blood, it's one of those ink pads, yeah. So I signed through my thumbprint. Now in this, my promissory note, I got 3 witnesses, 3 friends from work actually. I got them to sign that I signed it, but again you could get a notary to sign that as well. Okay, and you know, if I was going to do it again, I would get the notary just to get the wax stamp, and I would insist on the wax stamp there, yeah?
Just for you, just for you.
Or maybe a gold one, I don't know. And so yes, it's this is a basic promissory note. I don't have to go through this again, but the case law that says that it should be treated as cash. Okay. Now with the promissory note, I would do a notice of final settlement, right, to go with the promissory note. I would send it to the CFO, Chief Financial Officer, so you'll know what to do with it. Okay. This is to notify you that pursuant to the unrebutted affidavit dated date, a copy of which is enclosed, I hereby offer full and final settlement of the outstanding mortgage debt in cash by a security instrument similar to that which funded the original loan for the full value of the verified debt. The CFO is nominated and appointed fiduciary trustee for the purposes of this express agreement. The David Murphy and the bank are both operating national bankruptcy, who are therefore directed to discharge this account immediately and make or cause to be made all necessary adjustments. Notify the David Murphy in writing that this account is now discharged. If you wish to disclaim this appointment, you are directed to disclaim by deed immediately. Acceptance may be conveyed by non-response within 72 hours. If there's anything you don't understand, please contact me privately. So you're appointing them your fiduciary trustee. Yeah, you're telling them that I'm appointing you to deal with this money, deal with this matter. Here's the money, deal with it. That's their job, CFO. Okay. That goes with the promissory note as a kind of cover letter. Now I'm just going to play a little video. I probably won't play it all, but this is from Michael Tellinger.
To cut a long story short, one of the very important things that I learned was that banks accept payments in the form of bills of exchange and promissory notes. Now this didn't come from me, it was information that was spontaneously volunteered by Advocate Shem Simon, who represented Standard Bank. This is in my second or third hearing in the Supreme Court of Johannesburg, and he just suddenly blurted out, to our surprise, for some reason that still baffles me, that Standard Bank, which means all banks, accept payment in forms of bills of exchange and promissory notes. And I suddenly went, oh my goodness, this is very important information. Because if I had known this, I would have been able to do something about it long before I got myself into the court and had to stand there, defend myself against the fraudulent and criminal arguments of the banks. So, what I then went and did is I spent quite a lot of time with our legal advisor Raymond Dix, and we looked at the Bills of Exchange Act, the lawful act that guides the financial industry and how money works and how money is created, and guides the entire financial sector of our country, of Britain, of the United States and so forth. Every country has got their own equivalent of the Bills of Exchange Act. In South Africa, the Bills of Exchange Act comes from the British Bills of Exchange Act, which I believe is from 1822 or 1882 I think it was, and ours is just a slight bastardization of that British Bills of Exchange Act, slanted towards the needs of the people of South Africa, or the needs of the banks that govern and control the people in South Africa. So we created what we now use as a standard promissory note, and here's a basic example of it. We created a very nice fancy looking promissory note. Remember that all the bills in your wallet are actually, let's say, £100 or $100. It's a bill. It's a $100 bill, right? So just like, and it's a promissory note. It's supposed to be a promise to pay. To pay what? To pay $100 on demand, or it's become a very grey area actually. So what we're really in essence doing is we're not trying to find a clever way to wangle ourselves out of debt or whatever. We're using the laws and the system that was created, the corrupt and fraudulent system created by the banking fraternity and the banking cartel, to exploit and abuse and enslave humanity. We're using those same laws in our own favor, and somehow it seems to have worked. In my case, and the reason I'm sharing this with you, because I have now paid Standard Bank close to or just over 800,000 Rand with 4 different promissory notes from about June 2013 until the 12th of December, or was it 12th of October, 12th of October 2014. So over a 1.5 year period, I've paid the bank close to 800,000 Rand in promissory notes that I created. And this is, as I showed you, this is the basic standard promissory note. Firstly, it's called a promissory note. Then there's a space that you need to create your own code, the promissory note number, like the number on your bill, on any dollar bill or pound, you'll see there's a number. Okay, well, you make up the number because this is your note. So make up any number that's relevant to you, right? And then you write that number in there. Now, then what you do is you create a little index like this one here. As you can see, there are 4 entries on this index, and these are the 4 promissory notes that I've paid. So every promissory note that I pay, I write on this index along with the index number. So I write the date, I write the name of the recipient, and all 4 recipients here are Standard Bank of South Africa, Standard Bank of South Africa, right? And then the note number, and that note number is that number over there, so that you have a record of what you've paid out and what notes you've created, because now you're creating value. Remember, banks work with negotiable instruments. Negotiable instruments get their value from our signatures. The moment that I create this, every bill, every invoice, every statement that you sign in the bank, the moment you put your signature on that, you have turned that piece of paper into a negotiable instrument, because your signature creates the liquidity and the value in that piece of paper. So it turns it into a liquid negotiable instrument. And so this is what we're creating here. This promissory note becomes a liquid negotiable instrument with which the bank can trade. And that therein lies the interesting trick that we've encoded in this promissory note. If they haven't raised an objection within 7 days, that means they've accepted the note. Even if they raise an objection, they need to raise an objection to say, we don't accept your payment, in which case you tell them, well, this payment is the final settlement and it's delivered, which according to the bills of exchange means that the deal is concluded. Okay, and they need to raise an objection in the court and take you to court to say to the judge that they don't accept your form of payment. They can't just say, we don't accept your payment. They need to start legal procedure against you to say, we don't accept your payment, because this payment is legally sound according to the Bills of Exchange Act. You're exercising your right to use promissory note and bills of exchange to pay the bank. This is also very important. Please do not use these kinds of bills of exchange, or promissory notes rather. Do not use these promissory notes to pay other people, or to pay shops, or to pay other businesses, because that's not the intention here. They're just normal people like you, caught up in the same trap and the con by the banking fraternity. So only use this, and I have to stress this very, very loudly, only use promissory notes with banks and government institutions, because they are ultimately the instruments of the banks. Okay, if you use it with other people, you're going to get yourself into a lot of trouble. Don't do that. Now, you have to deliver this to either the bank's postal and legal document delivery. Don't go to the bank and hand it to the cashier. Okay, you don't deliver promissory notes in that way. That's just not going to work. You have to go to the bank head office and go to the post delivery or the legal document delivery office, and deliver this to the person that receives legal documents or the post. They will stamp, they have a stamp that they will stamp proof of delivery for you. Right, and this is critical, so that you've got these documents stamped. which proves that you've delivered it and they've accepted your notes in their office and their building. So there you can see. This is the letter. This was to Norton Rose, South Africa, the lawyers that represent Standard Bank, 12th of February 2014. And this was one of the promissory notes. And it says, find and close payment and final settlement to your client, Standard Bank, South Africa, regarding bill of costs. Okay, and bill of cost case number, and I put the case number, sincerely, Michael Tellinger, and then you take this with the original promissory note and your copy of the promissory note, and you deliver these three to the bank, postal receiving or the lawyer's legal document delivery office, and you make them stamp all these with proof of delivery. Then you put the attachment, the attached note that you wrote together with the promissory note, you put it in an envelope, you seal it, and you give it back to the guy that sits behind the desk, and you sign it. I normally sign it to the chief financial officer, because the chief financial officer will probably have a better idea what to do with this promissory note. And that's how I personally delivered all these promissory notes, bills of exchange, same thing, promissory notes. And just to show you the ones that I delivered, this is for 75,000 Rand on the 9th of June 2013. There you can see the police stamp and the date, and there you can see the receiving stamp, proof of delivery from the lawyer's office for Standard Bank. Okay, 75,000 Rand, 9th of June 2013. This is 82,000 Rand, 82,000 Rand, also on the same day, 9th of June 2013, all stamped. This was the letter that accompanied it, as I stated already, also stamped, proof of delivery, and then this was this was the third one that I delivered to them. This is a color copy of it, for 279,000 Rand. 279,000 Rand. That's a lot of money, people. That's like 4-5 times as much as the average South African earns per annum. Okay, and paid and delivered. And then the final promissory note that I delivered, as I showed earlier, on the 20th of November 2014, which is for the shortfall on the auction of my house, and that was for, this is a large one which I didn't deliver, but I can still sign it at any stage, 367,000 Rand for the shortfall on the auction of my house. So all in all, there are 4 promissory notes, as you can see on the promissory note index, and the total there is close to 800,000 Rand. In South Africa, that is an exorbitant amount of money. All these promissory notes have never been contested by the bank or by their lawyers, and as far as I'm concerned, the deal is closed. Any objection right now will have to become a new case, a new action in the court, to present to the judge why they did not accept or do not accept these promissory notes. Unfortunately, more than a year and a half has gone by and they have not raised any objections. So what has happened now is they have now set a precedent. So you can use my case wherever you are in the world, specifically in South Africa. You can use my case and what you see in this video as the precedent of delivering payment to banks and their lawyers and government organizations by means of a personal promissory note that you create in your home to whatever value or money amount you want to make it for. It can be $1 trillion, it can be $5, it doesn't matter. You make the money out of thin air. You create the value in that promissory note out of thin air, just like banks create money out of...
I also got this clipping. Now I did mention this yesterday, so you can switch off if you've seen it, yeah. But this newspaper clipping from Ireland, okay, and essentially it's about a guy, David Walsh, who watched the Irish finance minister in 2010 live on television write out a promissory note to the Anglo-Irish Bank, right, for 31 billion euro, right, live on television. Just wrote it out, and he handed it to the Irish Anglo Bank, and now they were bailed out, and they started trading again on the basis of this promissory note. So this guy, David Walsh, he thought, well, if they can do it, well, so can I. So he wrote a promissory note to pay off his sister's mortgage, and he went to court over it, and in the hearing he quoted the Bill of Exchange Act and Lord Denning's quote that I told you about, and the county registrar confirmed it was a valid defence. Now, here's the thing. I've searched around the internet for any results of this case, right? I couldn't find anything, nothing, zero, right? We've got people now in Ireland searching for this case. Can't find it anywhere. I've got somebody who's actually a bit of a honey trap, really. She's been chatting this guy up, this reporter, chatting him up, and then she turned around and said, yeah, I'd like to, could you tell me something about this case? Nothing. He clammed up straight away. So I think, personally, he was successful. Because if he failed, this would be splashed all over the internet. A man tries to pay a promissory note and is jailed or whatever. Yeah? But there's nothing about this anywhere. So, yeah, I think this was successful and they're not letting people know about it. But Michael Tellinger, his promissory note, he says, okay, you can claim on this promissory note by coming to my house on every other Thursday or something at this time, and I will pay you, which they won't do, okay? So because they'll get the promissory note and they'll sell it, just like any other security, yeah. But nobody's going to come to his house every other Thursday to. But yeah, that's his loophole. But you don't really need to do that, So anyway, so that's the first approach, okay? Just pay them. But if you've been paying attention to what's been going on, you wouldn't want to pay them anything. You don't want to pay them anymore. They've been stealing from you left, right, and centre. So I put that one in because just in case you're too scared to go any further. So the second approach is to turn the tables on them and lien on them. Okay. So with a commercial lien process. So with the commercial lien process, you don't go straight into it. You want to give them a first and final warning, right? It comes from this. Has anybody come across Sun Tzu, The Art of War? In Sun Tzu, The Art of War, they say, don't completely surround your enemy, because otherwise they will fight to the death. You always leave a little gap for them to escape, so they'll rather escape than fight to the death. So you're going to give them a first and final warning of what you're intending to do, and offer an opportunity for them to settle for a lesser amount. In this case, rescission of the contract, the full cash value of the security instrument, and a modest amount of damages, say $1 million. So then you essentially will write an affidavit, just like you did before, but setting a monetary value for it, saying, you've caused me a tort. By your fraud, you've caused me a tort, an injury, okay? And I value that injury at this much. When you think about it, over the course of your mortgage, the stress that you've had to go under to keep paying, making the payments, maybe you've lost your job, the amount of stress you're under to come up with that money, and maybe you've had arguments with your spouse over it. Maybe you've been thrown out of the house or argued and whatever, and all this stuff. You put a value on it, right? So yes, you put a value on it for it. Again, like before, you send a copy of the affidavit to the bank directors, and telling them they've literally got to rebut every point again. and again have it notarized by a notary, and then once you've got it matured as such, so once the 40 days are over, they fail to rebut it, you've got the final affidavit notarized, you put that on the public record as a debt. Okay, you can do that by taking out a small ad in the newspaper. Say publicly say a debt now. There is now a debt with Barclays Bank for this much, right, over a matter or whatever. Yeah, or you can even go to a court and say I'd like to put this debt on the public record, right? But once it's now on the public record, now it's a publicly recognised debt, okay, and you have the lawful ability to seize goods to the value of that debt, okay. So obviously most of us aren't going to be able to march down to Barclays Bank and start taking furniture out, right? Though that's what happened in the case of Guy Taylor. Somebody called Guy Taylor. He got a commercial lien out on his council over council tax, okay? And so one day he turned up at the council offices with a removals van and he started taking furniture out of the council offices, right? And the council called the police and he said, sorry, I've got a commercial lien here for goods to the value of. And the police went, okay. And so the council had to shut their offices in the middle of the day to stop them taking furniture out of them. Once you've got a commercial lien matured, you can lawfully take goods to the value, right? So the way we can do that, if you've been paying by direct debit, right, you can do the direct debit indemnity clawback, right? This is a guarantee that's set up so that if the money is taken out of your account in error, then they have to refund it. And you have the error in your back pocket, okay? It's the absolute truth that says they've been taking this money out in error because there was fraud, misrepresentation, all sorts of things, right? So once you've once you do this, the bank, right? And hopefully it's not the same bank that you get the mortgage out with, but the bank will have to refund every penny that you paid towards that mortgage, right? As I said yesterday, the bank will say we only oblige to hold records for 6 years, but they have every transaction. They don't lose any of those transactions, so you can go back all the way to the very first payment you made on that mortgage. Okay, and people have done that already. There have been people who've done that kind of in the ill-advised way, right, by just doing it without any of the lead up, right, and that's actually backfired on a couple of people. But if you've got the actual proof that there was an error, right, there's no way they can come back at you, because you can say, look, here's the truth, and you've agreed to it, right? So very standard template for doing the direct debit clawback. Very simple. Put the details of the direct debit there. Direct debit detailed above has been deducted from my account in error. Under the terms and conditions of direct debit guarantee, please recredit my account accordingly and confirm in writing once you've done so. I've copied this letter to the lender for their information. You send them a copy as well. So you're being completely sort of transparent and straightforward. As I said yesterday, just be persistent, right? The bank has now got lots of people doing this of the various different things. So they've been told, don't let them get through, don't let them do this as much as you can. But they have to, right? They can't avoid it. It's part of the direct debit facility that if there's an error, they have to refund. So be persistent, and if they point blank refuse, report them to the financial ombudsman. Right? Use their system against them, because that's what that financial ombudsman is for, and they'll be forced to refund you. Okay. Once you've got the lien in place, another thing you can do is you can notify the credit agencies, right, and get a black mark against the bank. right? And then you can invite bids from the debt collectors. If you've got like a let's say £10 million lien, right? They will, these debt collectors will absolutely want to buy it for, let's say, 100,000, yeah, or even maybe even 1 million, because they'll absolutely go after somebody for 10 million, yeah, and they will use the same tricks they use on us, on them, okay? They don't care. They're mercenaries. If they think they can get money, they'll buy it, okay? So use their system against them, okay? Everybody happy with that? Number 3, rescind the contract, right, by creating a dispute, okay? So you can dispute that the bank's claim that you owe anything, might owe them anything, with a formal challenge, right? The challenge will be, show me the note, right? Because if they're saying that you owe them something, they have to have the proof of that. They have to have the original note, right? This works actually with bank accounts and credit cards. Yeah, you say, I'd like to see the original, loan agreement with my wet signature on it. If you haven't got it, there's no proof of the loan. Okay, so we already know they don't have the note. It's gone. Okay, so the point is that if you start a dispute, you have the lawful excuse to withhold money until that dispute has been resolved. Okay.
You've got to show that you've got that money.
Sorry.
Have you got to show that you've got that money? You have to keep it in a separate account.
No. You're just saying, look, I've got a dispute with you because I don't think you've got the, it's like the gold watch. I've got a dispute. I don't think you've got my gold watch. Yeah. So until you show me that gold watch, I'm holding back the money until you show me. Yeah. If you get to that point where you can't pay the next mortgage payment, yeah. If you've already done the notices at the start, and you get to the point where you know you're not going to be able to pay the next one, create a dispute, and then now you can lawfully withhold your money, and until they can resolve the dispute, which they can't because we know it's all fraud. So when the bank fails to respond, go to court. You take them to court and get them and compel them to produce the evidence, produce the note. Okay, and then when they can't, you rescind the contract. Right. So this is where having a securitization audit would be really helpful, because that gives you proof they don't have the note. Right. Again, these days they'll say, yeah, we've destroyed the note, we lost it, and they can say, well, yeah, we do have it, we did have it, but it got destroyed. Right? So with that, you can say they're lying, you can show that they're lying. Okay. So as I said, the Americans are a lot further ahead than us. Right. So the video I'm going to show you now actually appeared on national television in America. Okay.
Hello, I'm Angie Moreski. The important question now is how can you use the Produce the Note strategy to help you save your home? Attorney John Yanchunas is joining us today to help give you some tips on how to proceed. John, thanks for joining us.
Thank you.
Well, first question here, is this something that anybody facing foreclosure can use?
Everybody should use it. Everybody should put the lender to the task of establishing that it owns the debt that it claims that you owe to it.
Now, is there a good indicator? I noticed as I've looked through some of the mortgage foreclosure complaints that the lenders file with the court, some of them actually have these counts in them that say reestablishment of note, and then the wording is actually the mortgage note has either been lost or destroyed, and the plaintiff is unable to state the manner in which this has occurred. They're admitting that they lost or destroyed the note.
Well, obviously that's the most, the best sign available that the lender doesn't have the note mortgage any longer.
So if you see that, or if you want to just try Produce the Note strategy, what's the first thing you should do?
Request through discovery that that instrument be produced to you. Once that's served on the lawyer representing the plaintiff's lawyer has got to respond within 30 days with the document requested. If it does not, then the consumer needs to go to court and ask the court to compel the plaintiff to produce that document.
So literally a letter or a document that you send to the court, and we'll have a template on the website to help people through that process. And why is that so important to prove what?
Well, it's important to prove that the lending institution that is suing you on the note or to foreclose your home is in fact the owner of the debt. The lending institution which originated the note and mortgage, the debt, may no longer be the owner. It may have transferred it to another institution, which in turn may have transferred it to another lending institution, and so on and so forth.
And you should also be careful looking at the fees and penalties that they're rolling into this request. Is that right?
That can be collected like property inspection fees, late charges, but so frequently we found that some lending institutions collect sums of money which are simply made up. They're, I think, designed to increase the lender's bottom line. For instance, a foreclosure fee, a pre-bankruptcy fee.
So keep an eye on all those fees which may be unfair and unwarranted.
Absolutely. In fact, you should ask the lender for proof that that sum of money was paid.
Obviously, if you're behind in your mortgage, this is not a way to just get your house for free. What are we trying to do here?
Well, it gives the consumer leverage or buys the consumer time to work out with that lending institution a repayment plan of the arrearage or the default.
Do you think judges will be receptive to this?
Oh, absolutely. I've tried it many times. I've done it for many years. Judges expect lawyers and parties who come before them to adhere to the letter of the law.
So if I'm the homeowner and I end up before a judge, what do I say? What's my plea?
Well, what I want is the lender to produce the original note and mortgage. If they cannot, then put them to the task of establishing why they can't, and that they are in fact the owner of the note and mortgage. And of course, more importantly, or just as important, that every element of the debt that the lender claims that the consumer owes is in fact owed.
So yes, having the note is the only evidence that there is an actual loan there. Okay, they haven't got it, then they can't chase you for repayments. Okay, so that would be the dispute that you literally start, and that's a defence. Okay. The last one, the most scary one, is to sue the banks. Now, when I say sue the banks, I'm not really talking about suing them, okay? Because that is, probably going to be a long, hard road. In fact, we've got there's a guy that I met in doing this talk in Poole in Dorset. He's actually suing the banks right now, and he said he's been compiling his process, all his documents and everything, and sort of documenting the whole process. And he says if he's successful, he's literally going to hand the whole process over to me, and get it out to everybody else. So Michael Benacia, okay. So remember the beginning part of this with the 3 strikes, right? That's all Michael Benacia talked about. Well, he did, kind of, right? Because if you remember, one of the case law was War and Others versus with the bank. That's him, okay? But he concentrated on those 3 strikes, essentially procedural errors by the bank. Not fraud, procedural errors. Now, Michael's a smart guy. If I can find out all this fraud, so can he. But he didn't concentrate on any of the actual fraud, just procedural errors, So I think he made a deal. I think he made a deal so his father, because it was all about his father's properties, his father could keep his properties as long as he doesn't talk about the fraud. Yeah, because if you watch his documentary, got nothing about the fraud. Just about those 3 things. Those are the 3 little. Oh, it's an error we made. It's okay. It's just an error. Yeah, we can correct that. Yeah, but no. Yeah. So instead of actually talking about actually suing the bank, right? We're going to do something. I hate sort of quoting the New Testament, but Matthew 5:25. Agree with thine adversary quickly, or thou art in the way with him, lest that at any time the adversary deliver thee to the judge. This is the basis of this idea that before you go to court, you're supposed to, try and resolve the matter between you. Okay? Then you take it to court if you can't resolve it. Alright? So, in that spirit, we'll send a letter before claim. Okay? So we're basically going to say, we're going to take you to court. Right? But before we do, here's one last chance for you. Right? So, dear sir, this serves as formal notice that we intend to initiate legal proceedings against the bank. We'll be seeking damages for the multiple acts of misrepresentation, failure to disclose and fraud perpetrated by the bank, as evidenced and agreed by the unrebutted affidavit, a copy of which is enclosed. The mortgage contract itself is unlawful and unenforceable for the following reasons. Right now, I'm not going to go through them, but they're essentially the 3 strikes and the phlegm test, right? So those 3 strikes of the procedural errors and why the contract is unenforceable, the phlegm test. Right, so I'm not going to go through them. It's basically just those things and the phlegm test, right? Additionally, we allege that the bank has acted fraudulently by misrepresentation, failure to disclose and abuse of position on numerous occasions throughout the term of this unenforceable mortgage contract. And we're going to go through the fraud and deception slide that I went through. Yeah, so list all the things that they did fraudulently. So that's essentially that slide. So I'm not going to go through that either. Due to the fraudulent nature of the bank's activities, intentionally designed to mislead through misrepresentation and a deceptive failure to disclose, the bank has caused us to suffer a tort, and as such, we require the return of the actual cash value of the original promissory note, plus a refund of all mortgage payments upon this fraudulent contract since its inception, as well as $1 million in damages. Yeah. Simon Spaniard, anybody heard of him? A guy called Simon Spaniard. He's actually helped somebody with a lien for, I think it was 50 million or something like that, and he got the bank to settle for no, it was 15 million or something like that, and he got the bank to settle for £800,000. It was a bit of a come down from 15 million, but still £100,000 get the bank to settle. So yes, $1 million in damages isn't that much really. And you put them out in numbers and words. We offer the bank the opportunity to settle this matter for a total of that total. You're reminded that under civil procedure rules, you're required to engage in constructive communication to minimise any possible need for assistance from the court. We look forward to hearing from you with your proposals for settlement within the next 14 days. So literally you're giving them an opportunity to deal with you, to negotiate with you, yeah, before taking them to court, right? And the lead up to this is that you've sent them notices, you've got an affidavit, right? Now you're saying you're ready to take them to court, right? So they know you're serious because you've got all this evidence you've acquired, right? Now you're threatening them with court, but you're giving them an out. Okay, does that make sense? Mm-hmm. So it's possible that they'll want to make a deal with you, but if they don't, right, then that's when you'll have to really start looking into, okay, how do I take them to court? And that's kind of beyond the scope of this, because unless we get them to go to court in a jury trial, a trial by jury, yeah, it's not going to go anywhere. But if we can get a trial by jury, right, it's all over for them, because pretty much no matter what type of jury you get, you're going to get jurors who've got mortgages. And when you go through this and you show the fraud, right, that jury's going to be on your side. Yeah.
What about a common law court?
Sorry?
What about a common law court?
Yes, but you know
How would you enforce it?
the system doesn't recognise, and the bank won't recognise, right? But it'd be interesting to do. Actually, that's a good idea, because I was thinking about doing a common law court about other things, just to get the idea out there. But that might be a good idea to start with, actually. I have to think about that. Okay. Right, so here's the thing. I don't know if you've come across this. You know, these are one of the smart cities they're talking about building. Yeah, this is the line. Yeah, so 9 million people in this building, which is like a few hundred yards across, and literally the walls are higher than the Empire State Building. And I don't see any doors in this. Yeah, so there's no way out. Okay, and your neighbourhoods are going to be like, I think it says in it, 5 minute neighbourhoods, not 15-minute neighbourhoods. Yeah, literally you're going to be stuck in this thing, right? And you know, I think it's a terrifying prospect. You know, 20 years ago, I would have looked at it and gone, wow, that's really cool. I'd love to live in there. But now I know what the bloody thing is there for, right? So no, this is a prison. Okay. The scary thing is they've already started building it. Yeah, this is Saudi Arabia, but it doesn't matter where, because if they get us under their CBDC, right? Well, they can say, right, you're all going to Saudi Arabia now. There's nothing you can do about it. Yeah, yeah. Well, otherwise they turn off your money. Yeah. So they're already started building this, and you know these guys are serious. I said this last night.
They've lost already. They've lost already.
I know, but we've still got to do our part.
Aye.
Yeah.
But they've lost.
I know. I believe that too. They've already lost, but we can't go. Well, they've already lost, so I'm just going to go. No,
we have to keep fighting, but we have beat them.
Yeah, but we have to do our part, right? So, yeah, I'm saying these guys are serious. They've virtually killed off half the planet already, right? Even though they
again with the jobs.
Yeah, and most those people don't know they're dead yet, but they're dead. So sorry, anybody's been jabbed. They're coming after your home because you'll own nothing and be happy. Yeah, they want you in those 15-minute cities or these smart cities, yeah, that they're building. Right, they need you in there, so you can't have your house anymore. Right, so they're coming after your houses no matter what. Right. I was going to give you a stirring speech, but found a guy who does a much better job.
Just think about it in your head. How bad do things have to get before you do something? Do they have to take away all your property? Do they have to license every activity that you want to engage in? Do they have to be throwing you on cattle cars before you start to say, now wait a minute, I don't think this is a good idea? How long is it going to be before you finally resist and say, no, I will not comply? Period. That's a different answer for each person. Ask yourself now, because sooner or later you're going to come to that line, and when they cross it, what are you going to say? Well, okay, cross this line. Okay, now cross that line. Okay, now cross this line. And pretty soon you're in a corner. Sooner or later, you've got to draw a line and stand your ground, whether anybody else does or not.
Pretty much, that's where we are, right? They're coming after us. They've been coming after us since September 11th, 2001. They've been coming after us, yeah. And we're coming to the end of this. Right? We can feel that we're near the end, because how much more ridiculous can it get? You know what they're doing to the children, what they do. You know, it can't get much worse. We're near the end of this, yeah. This thing only has value, has the value of the faith that we put in it. Yeah, we believe that this thing has some kind of value, so we act accordingly. We pretend that this is valuable in some way. Yeah. I realised the fraud behind it when I went away sometime, and I came back, and the stack of fivers I had were now not worth anything. And the plastic ones came in, and they said, "Oh no, these aren't worth anything anymore." So if somebody can wave their hand and say, "Well, no, that's not worth anything anymore," well, it never had any value in the first place. Yeah. So literally, all this is all the same. It's all toilet paper. Yeah. So what if we put our faith in the value of good people instead? Yeah. Why can't we do that? Why can't we say, I know you're a good person, yeah, so, I'll do this for you. I'll give you this, yeah, because I know you're a good person. Your credit's good with me, yeah. We're going into a world. We're in a world they call the zero trust world, where we're supposed to not trust anybody. That's why they've got all these cameras around, or the justification for the cameras and all the surveillance and all the online tracking and all that, because you can't trust anybody. You can't trust that people say that they are who they say they are, all this stuff, yeah. And because there's zero trust, well, now we can't trust the value of a person. We have to trust in the banks, the worst people to try and trust. Now, I was having an argument or a discussion with somebody, and he said that we need money. We need money because we need a medium of exchange. Okay, he said, if I've got 200 eggs, right, and I want a sheep, and the guy with the sheep doesn't want my eggs, well, we need money to be able to, as a medium of exchange. I said, why have you got 200 eggs? If you try and hoard 200 eggs, they're going to go off. Wouldn't it be better?
We know how to save them.
Okay. Wouldn't it be better if you just gave eggs to whoever wants them? Yeah? And what will happen is people are going to start to recognise you as that nice bloke who gives free eggs to people. Yeah? And then, the guy with the sheep will go, oh, and I hear that that nice bloke who gives eggs away needs a sheep. Yeah, mate, have a sheep. Yeah? It sounds like a bit of a utopia thing, but it's happened in my case. Yeah? At the beginning of this tour, I had my car taken by the cops. Okay? Long story, I'm not going to go into it here, but they took my car. And I was stuffed. It's like I just began this tour. I've got all these dates lined up, and I've got no car to get around. Right? So I literally said on Facebook, oh, I'm stuffed, I need a car. Somebody went, yeah, Dave, here's a car. He didn't know, I don't know him, he didn't know me, but he saw there was value. I had value in what I'm doing, so here you go, mate, have a car. Yeah? Another example is, because people often say, well, the mortgage, you need them, you need the mortgage, you've got a house for that. Even though it wasn't real, you got a house. Well, why are we paying for houses? There's a system in place right now, operating in this world right now, okay? Stop laughing, yeah? A system operating in this world right now, okay? Parallel to this debt-based, you got to pay for everything system, right? Where a couple who just got married will get a free house. Anybody apart from you know what that is? Anyone? No, have you heard of the Amish? Yeah? So a couple gets married, the whole community gets together and builds them a house for free. Right? No banks get involved, no mortgages. They get a house. And that's happening right now, today. Right? It's not a fanciful idea. It's happening. But we're stuck in this zero trust world where you have to pay to live somewhere on this earth. Well, right now, we have more empty houses in this country than there are homeless people. Literally. But the thought pattern behind this system is the same thought pattern as Tesco's pouring bleach over the food they're throwing away. Yeah? If you're not going to pay for it, you can't have it.
Don't
Yeah?
do that in our time.
Well,
The food project.
okay, well, that's what Tesco's, because Tesco started to see people dumpster diving, because they're literally throwing all this good food away because it's got out of date, right? You know, we'd rather let it go to waste or sit there and not do anything rather than let you have it, right? No, I think we ought to go to a system where we put faith in good people instead, right? So that's all I've got to say. I'll leave it at that. I hope that's